Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3,000,000% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
We still think the market can move higher in 2024.
I think this is a fairly decent nominal growth environment.
We do think that there is a chance that there will be upside surprises in the economy.
The U.S. economy might actually re-accelerate over the coming quarters.
We should be celebrating that this economy is quite good.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Your equity market on the S&P 500 positive here by 0.1% on the S&P, getting closer and closer back to all-time highs that we last hit in early January 2022. TK CPI, the next stop in this market, about an hour and 30 minutes away.
Markets are saying they love what they see, which is a disinflation tendency. I thought what Julia Coronado said was perfect. Dr. Coronado framing out 3-month annualized, 6-month annualized, 12-month annualized. We'll do that at 8:30. My guess is it's not Europe-like, but there's a tendency there to the shock of what we saw in Europe, 1.9%.
For 2 years now, this has been the number, the North Star for this market, for financial markets, for the Federal Reserve and policymakers, not just in the US, but arguably worldwide. Inflation. Is that beginning to shift? Are we closer to some kind of inflection point? Andrew Hollenhorst to Citi, attention is shifting away from tackling inflation and towards supporting employment, but policy actions will continue to depend, to some extent, on this inflation data?
I'll go with a shift. It's a nudgy thing. McKee's way better than you and I at this, but the basic idea is used cars. Oh, other things, groceries, food. Oh, the 12-month look-back's pretty constructive, but the animal in the room, whatever series you look at, is housing, rent, mortgages, yields. 30-year fixed comes in, and rent is the dominant statistic. For me to add, I'd like to know what David Rosenberg thinks.
8:30 Eastern Time, we'll talk about month-over-month disinflationary trends over the last 3 months, how it informs the Federal Reserve decision. We'll talk about all of that. This is the issue in the election campaign as well, Tom, but not month-over-month. It's about the cumulative inflation you and I have been talking about since 2020. The price climbing since then, services, goods. Yes, we've kind of faded the goods story, but still the food issue, rents, Tom, energy prices over the last 3-4 years, they're still hitting a lot of people hard across this country.
The level look back to, say, December 2019, January 2020, I think is legitimate. We don't capture that within the financial media very well. But the fact is also, with the advent of 2024, time marches on. It's going to be interesting to see how that phrase resonates at 8:30.
It's the calendar on the president's side. From New York City, let's get some scores for you in financial markets. On the S&P 500, we look a little something like this. Positive by 0.14%. Yields are lower by almost 5 basis points, 397.90 on a US 10-year. In foreign exchange, 109.80. That currency pair is positive by 0.05%. Here's the calendar. Your morning brief, it looks like this morning, 8:30 Eastern Time. CPI, jobless claims as well. It's not just about inflation, Tom. It is about claims too. 210,000 is the estimate for this morning. The previous read, 202.
Well, that goes to fully employed America. I've been talking about Columbus, Ohio, and good morning from the Ugly Tuna 2. Great bar out there. And you know, John, I look at fully employed America, and there's so many people watching this saying, Tom, you don't know what you're talking about. And even with claims, outstanding 4-week moving average is what I look at. There's a whole part of America that just doesn't buy the magnificent 2.8% unemployment rate of Ohio.
Without a doubt. There's a nice sequence this morning. You'll get the data and then you'll get the policy response to it, or at least the policy speaker responds. The Fed speak later today. Loretta Mester with Michael McKee. Thomas Parkin's going to be talking too in the next 24 hours. But Mester sitting down with McKee, Tom, 11:30 Eastern Time, live on TV and radio.
She is the Fed mathematician. It's going to be interesting to see what she says, and particularly off inflation data. And as I said at the top of the show, I'd overlay here PPI tomorrow. It's not like PPI, last in, first out and all that from another time and place, but there's a new importance to PPI. I'd like to hear what Mike McKee says about it.
And by the time we get to the weekend, you'll have the data, the Fed speak, and you'll have the bank earnings. JP Morgan, Bank of America,
Eric and Jerry,
Citi, Wells Fargo, Eric and Jerry, UBS.
JP Morgan.
It's very simple, Tom. Port in the storm, that's what she's saying. Things can get a little bit rocky, dicey, maybe volatile first few months of this year. Top pick, JP Morgan.
My zeitgeist headline over the holidays and the 4 or 5 days I had off, John, was the basic idea that JP Morgan captures 1 out of, I believe it's 5 profit dollars.
It's a stunning statistic.
In America. I mean, it's just amazing. Let's not forget Mike Mayo with his call that Citigroup load the boat. I mean, there's no other way to.
Yeah, looking for doubling over the next few years.
Right.
Getting behind the leadership of Jane Fraser. That's the banking story. Let's get the conversation started this hour with Skylar Montgomery-Koenig, Macro Strategy Director at TS Lombard. Skylar, wonderful to catch up with you. Let's go straight to the data in 85 minutes' time. What are you and the team looking for in CPI?
Yeah, I think the headline, or what we really need to focus on, isn't so much this print, but it's what we've seen since the summer of 2022, which is disinflation. So we got the peak of inflation in the U.S. in the summer of 2022, and a few months later, we got the peak in core. Now, we know that when inflation is higher, it's more volatile. You can see that clearly in the impact geopolitics has on commodity prices, which feeds into headline inflation automatically, and core through the impact it has on inputs. So we are getting inflation prints that are a bit hot. We saw that in Europe earlier this month. And core is definitely still too elevated for the Fed's comfort, but the trend is in the right direction, and that's the key for the market. So I think the disinflation story is what has legs, and it's really hard to dissuade the market of that unless we get a really large upside surprise.
Skylar, buried in your wonderful report is your mathiness from St. Andrews. You got scattered out charts with a regression line through it. How linked is EU inflation, 1.9%, major disinflation? How linked is their disinflation tendency with across the Atlantic Jerome Powell's disinflationary tendency?
So what I'll say is that European inflation certainly lags U.S. inflation. So after the peak we saw in U.S. inflation, we shortly got a peak in European inflation. The disinflation trend has picked up into the end of 2023. The big difference, though, between European inflation and U.S. inflation in the first instance was what was the main driver. In the U.S., it was both demand-driven as well as supply-driven. So the massive fiscal we got fed very strongly into the inflation in the U.S. In Europe, it was mostly supply-driven. And so that's why we're seeing such a large disinflation trend now, and it's accelerating. We expect it to be below 2% by the end of this year, because supply-side factors feed out quite quickly. Obviously, there are still risks in terms of geopolitics and the inflation supply shocks there, but I see European inflation falling quite quickly.
Okay, but then is the Fed behind? I mean, I've got a massive accommodation in the Bloomberg Financial Conditions Index. I got a lot of fancy people like you telling me this Fed is behind and we're waiting for March. What's the one June is the chat after that?
Yeah, middle of the year.
Yeah, March, June. I mean, come on, Skylar. Are they restrictive right now?
Yeah, I mean, but what's the rush, right? In terms of...
What do you mean, what's the rush? John's looking at 6 bedrooms somewhere in Manhattan. That's the rush.
Don't bring me into it.
I think that, the policy rate is certainly restricted, and it's certainly feeding into the economy, but the duration of U.S. debt is very long, and so it takes a while to feed through, right? In the U.K., you're looking at 2- and 5-year mortgages. In the U.S., it's 30 years. So it's a very small feed through, and so, why rush to cut rates when the economy is very strong and you still have inflation above target? What inflation being where it is and the downtrend we're seeing allows is for you to cut without seeing unemployment rise significantly, without seeing some kind of risk shock or recession shock. So that's what would really cause a rush, but right now we're not there.
Atlanta GDP now, John, 2.20%.
Let me tell you, I need to be perfectly transparent. I need more than a 25 basis point rate cut, Tom, to buy that property.
Don't we all?
25 basis points is not going to get it done.
But it gets the emotion going.
Sure, yeah, you grease the wheels. I get all that, sure. No, I understand all of that. Skylar, it does beg the question, though, when they start cutting, and I think for a lot of people this year is a matter of when and not if, what do you think they're going back to?
Yeah, absolutely. And this is really the timing issue, right? In terms of the market is looking for significant easing in 2024. There's no one that doesn't expect easing. I think the smallest easing that one is expected is 50 basis points. But it's all front-loaded. So the market price is around 200 basis points this easing cycle over the next 2 years. And I think that's fairly reasonable if you get a soft landing in terms of, it's still above their estimate of neutral, but maybe their estimate of neutral is too low. The problem is it's all front-loaded. Around 140 basis points of that is in 2024.
Which CPI series do you use in America? I'm on 3-month annualized just because the math's easy. Which one do you use?
I think you need to be looking at quite a lot of factors. I wouldn't look at headline that much because it's getting pinged around by what's happening in commodity prices. Really core, and as you say, the 3-month annualized is what you should be looking at for a broader trend rather than just having the numbers ping around because you have more volatile inflation because it's higher.
I mean, I look at 3-month annualized, and then you've got all the other series of Cleveland, the Dallas, this, that, and the other. Are they of value?
Yes, I mean, absolutely. I also think it's important to look at the survey measures, as you say, in terms of if you're looking at survey measures of inflation, they're all pointing to lower inflation as well. And that's something that Europe is more worried about, right? In terms of their sentiment surveys, people are more worried about sustained higher inflation. And so it's something that the Fed has going for that the ECB doesn't.
Skylar, we're here from President Lagarde a few times at the World Economic Forum in Davos, Switzerland next week. What are you expecting her to say based on what you heard in the news conference? We didn't get a repeat of Chairman Powell in that news conference the 24 hours after that December meeting at the Federal Reserve. Are you expecting a change from her anytime soon?
I'm actually very worried about the ECB because I think they've already over-tightened. They're trying to accelerate QT, which will make the squeeze even tighter, and the economy is already in stagnation, and it's already worried about that. And I think the ECB has too much focus on these supply-side shocks. And so the fact that we've had shipping costs rise and the fact that we're getting potentially higher January inflation out of Europe just because of the way the calendar rolls means that I'm worried that they're going to react more hawkishly and continue this hawkish stance that would squeeze the economy more and cause more pain.
This was excellent. Can I also just say that TK is very, very impressed with the bar behind you. For our listeners who can't get to a TV set, TK, that's a pretty impressive bar.
Well, they do
Casa
that. You know,
Skyler.
it's spring of junior year at St. Andrews. You do Bar 101. I mean, she can pop
It was
a
a rough
martini.
2023.
Skylar, this was great. It's fantastic to catch up. Let's catch up again soon. Skylar Montgomery Coning there of TS Lombard on the path ahead, Tom, for the Federal Reserve and for the ECB for that matter as well.
We're busting her chops. She was first in class in mathematics and
She's
statistics.
brilliant.
It's like a Loretta Mester in market economics. She's got her essay, folks, and we protect the copyright of all of our guests. Get it at TS Lombard. It's some sophisticated IMF-like stuff. I mean, no question about it.
You're going to say something else.
I was going to say something like that.
Not stuff.
I was waiting for a Bloody Mary from Skylar.
She's the real deal. It's great to catch up with Skylar this morning. From New York City, good morning to you all. If you are just joining us, welcome to the program on the S&P 500. Equity futures look like this, positive by 0.07%. Elsewhere in the bond market, yields are lower by 4 or 5 basis points. Let's call it 398.09. Getting some headlines, some comments from Secretary Blinken in Cairo, Egypt, speaking to reporters, saying the US wants to make sure Houthi violence stops, that Lebanon, Israel, and Hezbollah don't want an escalation. That's the fear. But Tom, sometimes things happen accidentally. What we saw yesterday, and we talked about it all through the morning, and we'll do so with Anne-Marie in just a moment again, Houthi rebels launching one of the most complex attacks in the Red Sea that we've seen to date. And the prospect, Tom, the potential that the US gets dragged into this almost by accident is something still on people's radar.
I am haunted forever, and it wasn't a drone. It was an Exocet missile in the Falkland Islands. This is not equivalent in any way to what the British saw in the Falkland Islands. But come on, you got 18 drones up in the air, I pretty much at the same time, I guess, and that's where you get, John, to where one thing breaks, and all of a sudden, we lose control. That's the worry.
Our attention is really going to turn to that in the next 10 minutes or so. Bloomberg's Anne-Marie up here in New York City is going to sit around the table and break down some of these issues and respond to the debate we saw last night between Governor DeSantis and Nikki Haley and the counter-programming we saw from the former President Donald Trump on Fox News at the same time yesterday evening. AMH is coming up next. Later in the hour, we'll catch up with Norman Rule, the former senior U.S. intelligence official. We'll catch up with him in about 30 minutes' time. Linda Dussel is coming up shortly as well in the next hour or so in the 8 a.m. hour from Federated Hermes to break down what she sees in this equity market and fixed income and beyond on this CPI Thursday. The inflation data, 8:30 Eastern time. That is just around the corner. Equity futures on the S&P just about positive from New York City this morning. Good morning.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
I think think what happened on January 6th was a terrible day, and I think President Trump will have to answer for it.
I think there's a larger issue Republicans have got to think of. Donald Trump's going to lose that appeal. He's going to end up going to trial in front of a stacked left-wing D.C. jury of all Democrats. I don't think he gets through that. And so what are we going to do as Republicans in terms of who we nominate for president?
That's what we need in our country. We don't need this chaos anymore. We need someone who's going to be a new generational leader that brings sanity back to America.
GOP presidential candidates Ron DeSantis, Nikki Haley on the CNN debate stage yesterday, the two sparring with each other before finding a common enemy, former President Donald Trump, who has been missing from all Republican debates so far. All this ahead of the Iowa caucus coming up on Monday. The campaign in TK already started last year. It's going to pick up big time in the next week.
You know, we were making jokes about it earlier. We had a really, thanks to our team, and stayed up all night putting together the best quality shots to video to capture the emotion of it. But John, I find, I mean, Anne-Marie Horton has like a real day job having to put up with the pettiness of what I heard last night. You have a governor of one of our most vibrant, dynamic states. You have someone who's done public service to the nation at the United Nations under huge rhetorical pressure, different debates and that, and they're talking at each other like it's a frat party, you know, freshman year.
Isn't that what politics has become?
It's what it's become.
Right?
That's the right word.
It was sort of like par for the course. It was unsurprising to me. Was it surprising to you?
No, it's not surprising. No, I can make a joke about it, but it's not. She can't make a joke about it. She has to live it. Joining us now, Anne-Marie Horton, Bloomberg rhetoric correspondent. Oh, I yearn for the old days. They're gone, aren't they?
Yeah, they are gone, for sure. And I think last night was a display of that. I mean, the fact that you have a Republican presidential debate without the front runner, I think Politico did a good job this morning saying this wasn't a split screen. This was a sideshow. And I'm talking about Governor Haley.
Right. Well, let's go to the main show, which is the president. We spent the last hour more on the side show with John Lieber of Eurasia Group. How did President Trump do last night?
Well, look, Iowa voters like him. Obviously, he's dominating in the polls, and you saw his ability to just talk about what he wants. You know, he's asked about the $8 trillion he added to the deficit, and instead he goes off on tangents about how Bidenomics isn't working, and how he is going to be the one that can make sure he releases America's energy independence. By the way, no one, I think, has told the former president that the United States is at record production, more than 13 million barrels a day. He said he would be able to do that. It's already happening.
It's beautiful. He knows that. Democrats won't correct him. Why? They don't want to talk about it either.
They don't want to talk about the fossil fuels that they're putting out into the world. They want to talk about the electrification of the grid that they're trying to make happen. But Donald Trump has a commanding lead in Iowa. What I think is more interesting, because I'm not sure if you guys talked about it yet, was that Chris Christie, though, yesterday suspended his campaign. Obviously, it was a long shot for him to ever become president. But New Hampshire becomes much more interesting now. There was a recent University of New Hampshire CNN poll which clearly shows 2/3 of his voters will go to Governor Haley or Ambassador Haley if he was to drop out. And he had this hot mic moment, which isn't boding well for anyone, even though people I'm talking to saying, well, he's just saying the quiet part out loud. Although a hot mic, he never meant to say this. I'm not sure if you caught what he said, but he basically says, you know, she's going to get destroyed.
Smoked. We talked about in the last hour that Ron DeSantis was somehow scared about what's to come. I think we're all assuming it's going to be Biden versus Trump. So let's talk about Biden versus Trump. That may well change, but that's the working assumption now. The president is trying to make this a choice between the former president, Donald Trump, and democracy. How successful is that going to be?
Well, it does come up in polls that people care about democracy. But at the same time, what comes up in polls time and time again is the economy. And that is why Trump continuously pivots to what he would do on the economy. He wants to make the Trump-era tax cuts in perpetuity. He wants them to be in law forever. So the economy is going to rank #1. Many people feel like they were doing better. But again, the timeline potentially is on Joe Biden's side. Inflation is coming down. All of your guests are talking about rate cuts. Potentially, people will go to the polls in November feeling better about where they stand economically and want to avoid the chaos that they felt under the Trump administration.
I can't believe we're going to have an economic domestic debate in October into the election, given the polarity on the culture wars around abortion and the border issues that both parties face. I just don't buy It's about the economy, stupid. Am I wrong?
Well, the Biden campaign is going to campaign heavily on abortion, and Trump last night gave them a soundbite that they could easily put to swing states that's going to make suburban women really want to go out to the polls and vote for Biden. And that was when Trump said, for years, more than 50 years, we've been trying to get rid of Roe v. Wade. I was the one that was able to do it. I got rid of Roe v. Wade. But Trump is trying to have his cake and eat it too when it comes to abortion. A voter said she's going out to the polls to vote, go out to the caucus to vote on this. She's leaning towards Trump, but she said, I'm a bit confused, Mr. President, about where you stand on abortion. Because Trump has also tried to distance himself from states that want 6 weeks bans. He said, some women last night, he said this, don't know at 6 weeks if they're even pregnant. And he said, while I want to make sure that we can be a pro-life party, he says we also need to win elections. So he's walking a very fine line on this, but the Biden camp is certainly going to hit him on this.
And on immigration, how's that? I mean, basically, a large part of the country is saying rebuild Trump's walls that everybody was, as a generalization, huge part of the nation was appalled about, and that's shifted, right?
Well, Trump is still saying he wants to build the wall, but this is something actually Ron DeSantis and others has hit him on. He came out and said, I'm going to build a wall, and then never did it.
But now things have changed, is how I...
Well, now things have changed in the sense that potentially we might get an immigration border package before the election. And actually, even though Biden has to deal with the progressives on this who really don't want to see any changes when it comes to parole or amnesty, a border package under Biden can actually help him going into November.
John Lieber of Eurasia was talking with us on the last hour about the rest of the world watching, the consequences of this election. Let's just talk about what's happening in the Red Sea at the moment. Norman Rawls joining us later on the programme, a good friend of yours I know. Houthi rebels launching a really complex attack in the last day or so. How's the international community responding to that?
They're very reactionary at the moment. No one has striked the Houthis within Yemen, a fragile peace agreement amongst a civil war there. But what we heard from Secretary Blinken as he's making this tour in the Middle East was yesterday, this was the quote he had to say, what I can tell you is that as we have made clear, many other countries made clear, there'll be consequences for the Houthis' actions. So now we're waiting for those consequences because right now it is costing companies a lot more money and time to avoid the Red Sea.
We're lucky, though, that damage hasn't been done to US military and to personnel. So let's talk about what might happen if it did happen. What if there is an accident? What's the response going to be?
Well, obviously the Pentagon will have plans of what it means to strike the Houthis within Yemen, and obviously they've been debating whether or not they were going to do that. I think people forget there are hundreds of men and women in U.S. uniforms still in Syria, still in Iraq, still in these places where it's incredibly dangerous for them right now.
I brought that up 2 days ago. Ian Bremmer has a fabulous chart of the Middle East in his your age group's top risks of the year that shows the dispersion of those American troops. I had no idea. It's not like 3 or 4 things, folks. It's 5, 6, 8, 10 geographies around country.
That is why there's been so much criticism about what happened with Lloyd Austin. You go in for an elective surgery, which we now know was for prostate cancer, and at the same time, you allowed your deputy to go on vacation in Puerto Rico. If you are a member of the military and you are overseas in a place like Syria or Iraq, that does not bode well.
AMH, thanks for the update. Got to turn some lighter news in the sporting world. TK, this widely expected, this from ESPN this morning. Bill Belichick and the New England Patriots are expected to part ways today after a remarkable 24 seasons together. I'm reading the reporting directly from ESPN, Tom, ending an unmatched run in the NFL history that included 6 Super Bowl titles. This according to league sources speaking to ESPN this morning.
At the time of year, but in the last, I'm going to say 18 hours, I'm guessing, Pete Carroll of Mina Kim's Seattle Seahawks advisor, whatever that means, Saban, you follow Alabama football.
Well, Nick Saban was a surprise to me.
Yeah.
The Alabama football program. I mean, he's getting on in years, TK. But
and now Belichick.
The guy's been dominant in the SEC. I certainly don't think this team this year is as good as teams gone by. But $11 million a year he was picking up, I think, in the Alabama football program, which is like...
But, I look at this, and the common theme here is they're all 72-ish, plus or minus 6 months, and this is a generational shift in coaching.
Yeah. Seeing a lot of that.
Yeah, we're seeing a lot of that.
From New York City this morning. Good morning. Michael Collins and P. Jim coming up shortly. Equity Futures, just about positive.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
2 hours away from the opening bell, 1 hour away from CPI data in America. The scores look like this on the S&P 500. Going into it all, equity futures positive by 0.16% on the S&P. On the NASDAQ TK, up by 0.39.
Let's do the levels right now, John. I think it's important here. On the Standard & Poor's 500, I'm sorry, as of today, I'm on the 5,000 watch. We're distant. 48.27 on SPX futures, 48.27. But John, after the gloom of the second and third of this year, I'm sorry, up 170 points in the SPX to get to 5,000 has my attention. You're on a 38,000 watch, not a record high in the Dow. And NASDAQ 100 popping back to 17,000. I believe I saw a chart. I'll give Zero Hedge credit that the Magnificent Seven sort of burst through yesterday, even if it wasn't Apple helping.
48.18 is the all-time high. 47.83 was the close in yesterday's session. So we're getting closer and closer. The next stop, the data, and then we get the earnings. The banks this morning and the pre-market shaping up as follows. JP Morgan over the year, Tom, over the year up by something like 22.48%, which has been absolutely phenomenal.
Yeah, this is going to go, I'm going to give Gina Martin Adams all the love here, but there's a lot of other people with her saying there's just an underestimating of earnings, and the pulsing here of the stock market tells me maybe there's an adjustment here from mid-single digit up to top single digit as well.
Top pick, JP Morgan, Erica Nigerian over at UBS.
Top pick, Mike Mayo,
seen so much of that.
I mean, everybody's got their favorite.
Looking for a big move, without a doubt. Let's turn to the bond market briefly, chop it up for you. 2-year, 10-year, 30-year, as always, going into the data, 398. Yields down by 4 or 5 basis points. Yields on the 10-year, Tom, 4 straight days, closing in and around 4%, above 4% over the last 4 days.
That's a nominal yield. That'll play off where we are in 1 hour, make it 59 minutes. But, John, I'm going to do a real yield analysis here, and there is a raging debate about what the inflation-adjusted yield does. And as Julia Coronado said, interest rates are up, and it's put a brake on all sorts of business transactions, including commercial real estate. Maybe something comes to the rescue here, as Priya Misra would suggest.
And for people maybe looking for properties in New York City, Tom, facing sky-high mortgage rates and hoping they might come down sometime soon.
But like, I think you said this, John, coming down one rate cut ain't going to do it.
No.
But do you get a demonstrable drop off of the inflation trend that will be reaffirmed here in 58 minutes?
TK, I was just absolutely shocked to see the numbers, the New York property sales and the composition of them. How much of it is cash? It's just shocking, amazing to see.
I think that's in a lot of cities worldwide. I mean, it's become a property investment, a sinkhole where
people of a certain age have built up a lot of equity in their homes. And they've built up a big cash pile as well. Let's get some top stories under surveillance this morning. Just under an hour away from the December CPI report, Bloomberg Economics expecting the data to show inflation making progress towards the Fed's 2% goal, but still running at a pace closer to 3%. Plenty of Fed reaction to this, including New York Fed President John Williams, saying their current policy is tight enough to bring inflation down towards their goal, and he expects interest rates to come down over time. Tom, I'm interested to see the additional Fed speak today following the numbers we get a little bit later.
I'm interested in the Yardeni speak. Edward Yardeni suggests there's a few items that may give you a surprise lower, including all the housing, OER and all the rest of it, rents and all. You may get a number that's a little more disinflationary than expected.
You've been itching to talk about this story all morning. This time it is real. It is not a hoax. US regulators approving the first ETFs that invest directly in Bitcoin. The SEC's landmark decision broadening access to the largest cryptocurrency in the roughly $1.7 trillion digital assets sector. The breakthrough will allow investors to buy Bitcoin as easily as stocks or mutual funds. Bitcoin ETFs expected to start trading when markets open today.
Eric Balchunas is out on Twitter. If you want to follow this, folks, follow Eric Balchunas on Twitter, who's looking tick by tick here at 7:34 a.m. at the asset sizes. I don't understand what he's doing because I don't understand Bitcoin, but the answer is billions are involved here, and I'm absolutely shocked, John. If you see price come in, you speculate, as Raphael Auer at the BIS would say, and Bitcoin pops 47,000 up 2.7% right now. Do we close above 50,000 by this afternoon? Why not?
I don't know, but Eric is absolutely awesome, and that's something we both know. Let's finish on this story. I love this story. A great year to be a European traveller. The 2024 Henley Passport Index is out with rankings of the most powerful passports for visa-free travel. I always ask this question, and it surprises people when they get this answer, Tom. Residents of France, Germany, Italy, and Spain now have easy access to 194 of 227 destinations, 3 more than last year, and they now join Singapore and Japan, who've enjoyed the world's most powerful travel documents for the last 5 years. The UK is 4th, the US is in 7th place.
But they still have to stand in that other EU line at JFK. Have you ever looked over there? I mean, you get 4 or 5 big flights.
I mean, I'm a permanent resident in this country, Tom, so I don't have to go in that super long line in America anymore. Global entry is helpful as well, although that line has got recently too.
The backup for me in New York on global entry is so big I've never done it. But oh my word, all those Advantage passport stories, and the answer is the line at JFK can get a little bit long. He's never been in that line. Michael Collins briefs now, senior portfolio manager, debt at PGIM. He watched every minute of Prudential's coverage of the Rose Bowl and the Michigan victory there a few days ago. Michael Collins, I'm going to look at the Rose Bowl here, the bond market. How will yield react off the CPI today? If we reaffirm disinflation, where across the yield curve will we see the biggest adjustment?
Yeah, Tom, Jonathan, good morning. I'm a big football fan, but I'm probably more excited about today's CPI print than I am the NFL playoff games this weekend. To be honest with you, tells you what a bond geek I am. But I actually think that disinflation is becoming more entrenched, Jonathan and Tom. Notwithstanding, the big jump in freight charges we've seen as a result of geopolitical risk, but you are seeing more evidence that things like housing are starting to unravel a little bit. I think you're seeing more evidence that the big surge in multifamily construction that is still to come online is going to cause rents to come down. So if you have housing at zero, you have goods already at zero or negative territory. Even if services and wages get stuck in the 4s, that puts average inflation in the mid-2s, right? So I think you're on that trajectory, and I think the Fed is ultimately going to have to play catch-up.
So do you model out, I haven't asked this question in ages, but I agree with you, and more importantly, Ed Yardeni agrees with you on the surprises we may see in housing disinflation. What does it do to the 2-10 vanilla yield curve? I mean, right now we've been inverted since time began, and what do we do? How does that react off of today's report?
Yeah, I mean, the playbook, as you know, Tom, is that the curve, bull steepens. The front end rallies more than the rest of the curve. That's, I think, what's in the cards over the intermediate term, meaning over the next year or two. In the next few months, though, if you're looking to trade this, I mean, it's really tough to be long kind of that, 2 and 3 and 4 year part of the curve, because as you know, there are a lot of rate cuts that are priced in the near term, starting, as early as in 2 months from now, that may not come to fruition. I mean, the Fed is good at waiting and watching and lagging, right? They lagged on the way up, and they are probably going to wait too long and keep rates too high for too long before they cut, and then they're going to have to cut more aggressively. So I think that's really the timing of what's going to happen. But ultimately, in 2 years from now, I think the curve will resume a more normal upward sloping shape.
Michael, this is a little bit of a subtle shift from you. I've been following you for a long, long time. You know that. You haven't been super bearish, anything but. You've been constructive on certain parts of credit. I've noticed you've lightened up recently on credit exposure. Michael, can you tell us just exactly why and what's changed over the last few months? Is it price? Is it fundamentals? What is it?
It's more price than fundamentals, right? If you look at the fundamentals, I mean, the economy is actually doing great. It continues to surprise in terms of its resilience. I mean, it seems like the whole soft landing is happening, right? I mean, if you do have a recession, and we have a 25% recession probability, which is elevated relative to historical averages, but it's not going to be a hard landing, right? The probability of like this big existential credit crisis where defaults spike and consumers default and businesses go out is really, really low. You just don't have the leverage in the private sector to cause that impetus, right? So I think that bodes well for fundamentals. I mean, but credit fundamentals are deteriorating on the margin. They're definitely not improving, but it's really the price, Jonathan. I mean, if you look at what's happened with credit spreads, they snapped in dramatically through the end of last year, along with rates rallying, along with volatility coming down, along with stocks going up, and they're kind of getting to the low end of their historical ranges in an environment where there's still a ton of economic and geopolitical uncertainty. So I think it's more, be patient here, take some chips off the table, wait for better opportunities to reload on credit.
So does that mean clip the coupon as a general statement after a fairly robust 2023?
Yeah, I think you clip the coupon in fixed income, and I think you're still earning attractive yields. I think interest rates across all sectors of fixed income are going to be lower in a couple of years from now than they are today. So I think you clip the coupon for now. Look for opportunities. If rates back up, you buy them. If credit spreads widen, you buy them. I think that's the world we're in. You have this Fed backstop, which you haven't had in a long time.
With immense respect for PGIM and all the awards you've won for total return, how do you and the team there frame the debacle of the last 3 years? Do you frame that someday we'll get back to where the Bloomberg Total Return Index was in bond, that we will see true appreciation, or is that a time long gone?
No, we're back right to where we were 20 years ago, Tom. We look at beginning yields, and the big index everybody in fixed income uses is your Bloomberg Aggregate Bond Index, which is yielding 4.6%. And we are trying to beat that, right, by 1 to 2%. So if you just kind of do that simple math, you're looking at mid plus single digit type of expected returns in high quality, diversified fixed income, over the next 5 or 10 years, right? That's the beginning yield on high quality fixed income is a really good predictor of ultimate return. So the last 10 years it really has been the lost decade in fixed income. It's been more than 2 or 3. It's been returns in the really low single digits. But that's behind us, right? The forward-looking view on fixed income is much more constructive.
Michael Collins, you are one of the absolute best over at PGIM. I love catching up with you. Mike Collins there at PGIM. Thanks for being with us, sir. Appreciate it. If you are just joining us, welcome to the program. CPI just around the corner. Equity futures on the S&P 500 look like this going into that. We're positive by 0.17%. Breaking news just moments ago. Another EV reality check. This time from the car rental company Hertz to sell about 20,000 electric vehicles from its US fleet, 20,000, and to reinvest a portion of proceeds into internal combustion engine vehicles. And Tom, the action to better balance supply versus expected EV demand. That is another big reality check for this push?
I'm not up to speed on what this means, but my operative word is massive. This is a massive signal from Mother Hertz. And I love what they do within the press release. They say ice. I'm like, I have no idea what ice is. I'm thinking of vanilla. And the answer is, John, as you say, we're getting out of EV and we're going back to old technology. And I'm certain within their analysis and the sell side at work, it's going to be because their customers told them.
Precisely. They've got to slow down. Now, if you speak to the automakers about this, they'll talk about a change in execution, not strategy. Seems to me that's the same approach from Hertz this morning, Tom, because when you look at the 20,000, that deal represents about 1/3 of the global EV fleet. They're trying to do too much too soon relative to the demand that exists right now. Hertz is experiencing that. Other automakers are experiencing that to some degree as well. We've seen headline after headline, Tom, speaking to the same theme.
Ian Bremmer out with a beautiful chart today on the minerals that China dominates in, and they dominate in battery technology because they've got the raw materials. Some of them I couldn't pronounce. I'm not sure what they were. But
you get to the airport, Tom, you rent a car, right? You're in a new state, a new city, you're not sure where you're going. You don't know where the chargers are.
Usually they're out
You've got that anxiety. You're getting an internal combustion engine car, aren't you? Isn't that the preference?
I do like internal combustion.
From New York City, this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Lots of danger points. We're trying to deal with each of them. We want to make sure, through diplomacy, that we can create enough security and a strong sense of security so that people in Israel who've been forced from their homes can move back. People in southern Lebanon who've been forced from their homes can move back. I think no one wants to see escalation there. Israel doesn't. Lebanon doesn't. I actually don't think Hezbollah does. So we're working on that.
Happening just moments ago, that was U.S. Secretary of State Antony Blinken speaking in Cairo to reporters on the latest developments in Middle East tensions. TK, that intense period of diplomacy for the Secretary of State has been non-stop, hasn't it, since early October?
Non-stop and multi-front, and certainly the conversations we've had here in surveillance have not been centered just on Gaza and the horror that we see in Gaza, but it rolls right over to the eastern side of the West Bank and on up to Hezbollah. And then all of a sudden, you've got a fourth front, I'm going to call it, in the Red Sea as well. And John, it's a little, is it hour by hour? No, but it's half day by half day, definitely. The news flow is
the news yesterday was extraordinary, Tom, that we've got U.S. forces and allies shooting down 18 drones and a barrage of missiles aimed at these merchant shipping lanes. Tom, accidents can happen, and we're fortunate that accidents haven't happened, and that so far the U.S. and its allies have been successful to some extent. Is it acting as a deterrent to stop them? No, it hasn't worked at all. to that extent, Tom, because the likes of AP and Immerse, as we know, the big container shipping giants, the merchant ships, Tom, are not using the Red Sea as they were a month or so ago.
Let's have a delicate conversation on this right now, and it's a conversation of geography and technology. Norman Rule, Senior Non-Resident Advisor for Transnational Threats Project at CSIS, and working for America as a former senior U.S. intelligence official. Norman, I got 8 ways to go, but when I look through the literature and the zeitgeist, it's not like from Butch Cassidy, who are these guys? It's more, where are these guys? Where are the drones coming from? Where are the Houthi established geographically as they attack ships in the Red Sea?
Good morning. Houthi forces and control is generally in the western portion of Yemen, which focuses on the Red Sea and the Gulf of Aden. There are not only missiles, drones, explosive boats, and mine capabilities that must be monitored, but some of these capabilities are mobile. Missile launchers are mobile. Drone sites can be trucks or barren fields. So this requires intensive and dynamic intelligence collection if one is to look at targeting these facilities for military action.
Do we do this alone, or do we collect intelligence, particularly with the Houthis' great adversary, Saudi Arabia?
The nature of U.S. intelligence collection for military operations in this scenario would likely be done by U.S. and British and allied forces who would be involved in any potential kinetic action. The Saudis would not be playing a role in kinetic action, so their involvement would be limited, if any.
Norman, this is causing a massive disruption. I'm just wondering how cheap it is to cause this disruption. How sophisticated is the military arsenal of, say, the Houthi rebels? How sophisticated, how cheap is it?
The military capabilities of the Houthis are relatively sophisticated in terms of missiles, but this is an older technology. Iran has provided it. Iran has provided the training in Yemen and in Iran itself. And in essence, when the military tends to look at these targets, there is the issue of a missile that costs so many thousands of dollars or a drone so many tens of dollars versus a $2 million anti-ballistic missile. But the idea of, well, what damage could that drone or Houthi missile cause really becomes part of that economic equation.
Norman, U.S. forces and allies, the mere presence in the Red Sea is meant to act as a deterrent. It's not. They're now intercepting missiles. What happens if they fail to intercept one of those missiles? Have we given thought, Norman, I'm sure you have, as to what would happen next as a consequence?
So I think it is fair to say that the U.S. and partner presence, to include the United Kingdom, has shaped Houthi behavior and likely deterred some scale of their action. This said, if a Houthi missile were to strike, say, the bridge of a container ship, and it were to sit in flames in the Gulf, or to strike the bridge of a tanker, or worse yet, to cause significant damage on an oil tanker, that would be dramatic. A significant oil leak in the Red Sea would shut down all shipping.
I mean, a really naive question, Norman, but I've got to go there. So a drone goes up in the air, and does a pro like you go, oh, we'll knock it down? I mean, is it like skeet shooting on a Sunday where, you know, the clay pigeon's up there and you just nail that puppy? Or is it sort of blind luck-ish that we're knocking down these drones? Which is it?
Well, I'm not a pro and I've not been involved in those angles, but it is not blind luck. This involves precision weaponry and a tremendous amount of training, and our NAVCENT and CENTCOM personnel go through a tremendous amount of training for this sort of event throughout the year.
So when we bring this forward, and let's take it back to the Secretary of State doing shuttle diplomacy, who does he want to talk to have a change agent for the Houthis? Does the Secretary need to go to Tehran and begin a dialogue with people that we don't want to have a dialogue with?
Such a dialogue, which would be unadvised, unjudicious, would have no impact on Iran's behavior. Iran's proxies throughout the region are following a consistent pattern of aggression against the United States and Israel. The United States does send messages indirectly to Iran through a variety of partners, people who have diplomatic relations with Tehran, but it has no effect, and it's not anticipated to have any impact.
Norman, ultimately what we're getting at here is what is the risk, the potential that this war could spread, as we know in the last week, and you and I talked about it. Top Hamas official killed in Lebanon. That potentially was a source of escalation. It hasn't been so far. How do you think that is contained at the moment? How contained is the risk of a broader conflict?
Well, there continue to be no strategic drivers for Iran or its proxies to engage in a conventional conflict or risk a wide-range formal conflict, because that threatens many of their domestic political and economic initiatives. At the same time, there are multiple reasons for Iran and its proxies to maintain the current level of violence and even escalate that level of violence as they've crossed red lines and some of the violence is normal.
Norman, one final question, and we are thrilled with your commitment to surveillance. You've really come on since day one here and given us perspective. This seems to be deteriorating. Away from the media coverage, the immediacy of images in Gaza and all. Is that correct in Washington among institutions, including your CIA? Is this a deteriorating situation?
I would say it's an evolving situation, and it's evolving somewhat predictably. In the absence of deterrent action against Iran and its proxies, they're continuing to maintain some sort of an approach to upset the regional security. Here's your worry. If we undertake a two-state solution, diplomatic effort, do we expect Iran and its proxies to stand by while Palestinian relations with Israel are normalized? That's unlikely. So I don't see that there's been sufficient diplomatic effort by the international community to say, how do we constrain Iran and its proxies from upsetting peace in the region?
So true. Norman, thank you, sir, for your input this morning. Norman Rule there of CSIS, a former senior US intelligence official. TK, crude this morning, 72.82. Crude actually higher this morning by 2%. On Brent crude, 78.25, up by 1.9%.
You wonder what the energy stocks will do off the Hertz announcement. I mean, there's the geopolitics and Brent crude running off that, but I don't take lightly this write-down. They couched it in the phrase depreciating accounting, but this write-down of EV against all the ESG change of tone you're going to see in Davos. I mean, I know you were going to do an entire hour devoted to ESG in Davos, and you couldn't find three people to line up.
Is that what you were assigning me?
I remember being there. Savita Subramanian at Bank of
was
America.
Great. Yes, she was great.
Who owned the high ground on this and still does in terms of very careful adult math. That's away from the branding, the blather, and here you are, Hertz, thrown in the towel before Davos.
Kind of. Just incrementally pulling back, not completely throwing in the towel. So we're talking about 20,000 EVs, but I agree with you, Tom, it's a really important story. Just to share some numbers with you, 11% of the total fleet was EVs, 80% of that Teslas. So you're going to get a fair amount of Teslas hitting the car market, Tom.
If I get a Tesla, folks, seriously, on Lyft or Uber, I have to cancel it.
Oh, you don't
I
fit?
can't get in it. I mean,
I think that's a unique problem.
The first time
I think that's
a
unique
Tesla,
problem, sure.
I was going beneath 59th Street, and I'm driving the whole way like this,
I'd be nervous about buying an EV.
Help me get up.
I'd be nervous about buying an EV in the second-hand car market.
Thank
Wouldn't
you.
you? Wouldn't you want the warranty?
Yes.
From the manufacturer?
Yeah. I mean,
I'd be a little bit nervous about that. Linda Dussel of Federated Hermes coming up next. In the next hour, CPI in America, 8:30 Eastern Time. Equity futures positive here on the S&P 500, up by 0.1%.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg.
Right now, the consumer is starting to feel a little bit better. Inflation is going to continue to come down.
I think inflation is going to keep trending lower.
It's fair to say data dependency will continue to be key.
As long as the labour market is holding up as strong as it is, then I think consumer discretionary can do well.
Until we see a slowdown in the labour market, the consumer can continue to run here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bramo on assignment this morning in this important half hour, a measurement of your inflation across America. We'll have that for you at 8:30 with Michael McKee. Its ramifications in the market. Linda Dissel will join us from Federated on why you're not in the stock market. And you got to believe, John, the economic reports and what we see from the banks tomorrow folds right in to the equity tone.
Yeah, two-part story. 1-2 punch for this market over the next 24 hours. Data this morning and then earnings tomorrow. CPI a little bit later, together with initial jobless claims. Then bank earnings, JP Morgan leading the pack tomorrow morning. Looking forward to covering all of that with you. The Federal Reserve, what do the CPI numbers mean for them? And Tom, is March too soon to consider easing policy and reducing interest rates?
It's interesting to see. I didn't see the note, but I know Goldman Sachs is republishing Hotsias about March, June, and all that. And I guess that gets readjusted here at 8:30 and then gets readjusted with Michael McKee's conversation with Loretta Mester of Cleveland, where she'll give the tea leaves out. Like, did you see the headlines off Williams yesterday?
Yeah, sure.
Well, I sort of kind of think like this, and come on, it's about the economic data. They're data dependent, and you're going to be dependent for 26 minutes here, 29 minutes, excuse me, here.
I'll share a quote with you, shall I? Yeah. As inflation comes down over time, my expectation is interest rates will also come down over time.
There we go.
The timing of when that happens and the speed at which that happens will depend on how inflation evolves and how the economy evolves. So how far? We're going to find out how inflation evolves in about 28 minutes.
If I said that on air, the audience and you would put me in the timeout chair.
They'd go to sleep.
Wait, I was already in
it.
the timeout chair.
No doubt about it. CPI a little bit later. We also need to talk about Hertz. This story is fascinating.
Yeah.
20,000 EVs are going to be sold by Hertz. We saw some subtle signs of this back in October when we heard from the CEO. What's interesting about this, Tom, is not just about demand, it's also about the cost of carrying these cars at a company like Hertz. So on demand, this is what they've got to say. The company expects to reinvest a portion of the proceeds from the sale of EVs into the purchase of internal combustion engine vehicles to meet customer demand. The company expects this action to better balance supply against expected demand of EVs. But earlier last year, late last year, Tom, the CEO was talking about the cost of carrying EVs, higher repair costs compared to the rest of their cars.
Yeah.
That's what a lot of people are going to find out.
I don't want. Good morning, Mr. Musk. I know you watch every morning, but I'm not going to pick on Tesla here about EVs in general. I think there is a real worry here about the repairs. But you nailed it, John, with what are we talking about here? Let's sum together, before we get to Linda, do the data check as well. What are we talking about within the blather of early January? What we're talking about, and Julia Coronado nailed it, and John Farrow nailed this, is the cost of carry. And when you go to Happy Valley this week at Davos, that's a difference in this year's Davos.
Without a doubt.
All of a sudden, there's a finance rate for everything the great and worthy want to do.
This is the distinction, Tom, between speed and destination. The crew at Davos at a World Economic Forum are going to talk up the destination. They're going to get everyone to say, yes, this is where we need to end up. And then they're aggressively going to push the speed, how quickly you get there. But we've seen reality check after reality check from companies and from consumers as well, Tom, as to how fast we can actually get there. And I think what this is about, it's not a change of destination yet. I don't know if that destination will ultimately change. The objectives haven't shifted, but the speed at which you're going to achieve them, clearly, this is another reality check.
I'll go Davos on you. It's about the journey and
yeah.
the real yield.
You're going to hear a lot
as
of that.
well. Linda Dissel in moments. Just moments ago, Craig Trudell of Detroit will join us on ICE here. I love that.
Internal combustion engines. Okay, looking forward to that. A little bit later this hour, 8:45 Eastern Time. TK, the scores look like this on the S&P, positive by 0.1%. Just a little lift here going into the data. Yield to lower, TK, down by 4 basis points, 398.85.
Without question, the most important interview of the day, the conversation of the day on your courage to be in the equity markets. Linda Dissel, senior equity strategist at Federated Hermes. With all the troops at Federated, there's been a lot of experience in cycles. Linda, what did the team do at Federated on January 2nd and 3rd when the world collapsed for the Magnificent Seven?
Well, we like the Magnificent Seven, but we feel pretty good about the year ahead because we're looking for broadening. And I'm sure lots of people are talking about broadening of this market. You know, last year was the easy year. Last year we had lots of easy money and we were spending it. And profit margins are what really surprised all the naysayers last year. This year should be harder, but which way are we going? Are we going into a recession now, or did we have a rolling recession already? And you know what? It doesn't even really matter, because if we go into recession, our dividend stocks are extremely cheap. Nobody's been looking at them for years. And if we're not going into recession, then the early cycle stuff, that's that small cap, particularly growth stocks, and those financial stocks are really inexpensive. They've been hit hard, 50%.
You and I you don't remember this. Unfortunately, Steve Auth and I do remember 1977, where we came out of the horrific 75 first bull market leg, and then surprise in 77, there was that second leg nobody saw coming. How do you have a second leg of a bull market? Is it at the revenue line?
Well, it's the revenue line will be more challenging. It's interesting that you bring up the 70s, because in the 70s you had an inflationary problem. That's good news for the top line until it starts to really eat at your expenses, and then it hurts your bottom line. And that's what we're looking at this time. Are we repeating the 70s, where we claim victory too soon, where the Fed maybe cuts too soon, but actually companies are having a harder time with their margins because they don't have that top line growth that they did when there was strong inflation. So good news, it's coming down. But what about those wages that keep going up, 4 and 5% a year? That's where we have to watch the margins, and that's what we're really going to be listening for in the earnings season.
Let's get into it. Defending those margins, Linda. Who's doing a good job of that right now?
That's going to be a stock picker's question as to who does the best. And I think this is where, as you were talking about, where we're going, our destination and how fast we get there, how fast can companies incorporate the benefits of artificial intelligence to help their productivity to advance? So I think this is going to be much more of a stock picker's market. It's not necessarily in sectors, which is why you can't throw the baby out with the bathwater. Interestingly, when we talk about small cap stocks, particularly in the growth area being inexpensive, people want to know which ones are the profitable small cap stocks. They are historically inexpensive. You have to go all the way back to 2000 to see them being this inexpensive. So that's where you have to really, roll up your sleeves, and do your work on the individual names.
We're dancing around the elephant in the room. We're talking about defending margins, AI adoption. Linda, aren't we just talking about job cuts here? And given where claims are at the moment, at 2:02, we get an update in about 12 minutes time, 22 minutes time. Linda, where do you expect claims unemployment to be as we close out this year, given what you've just suggested?
Well, I don't think we should blame AI for job cuts. I think if you're worried about losing your job to AI, you should worry about losing your job to someone who understands how AI can help your company and their profit margins. But as we look at the employment situation, and we're at a near record low or record low on the unemployment rate, it's hard to really imagine that gets too much worse when the labor market is so very tight. But what we're going to watch there is something that has been termed the rich session, where people making $125,000 or more, those people that are being labor hoarded by companies who paid much more for them than they would have just 3 years ago, are having to cut costs because of a margin problem. And then we see that maybe rolling across the economy or across industries.
Linda, I am absolutely fascinated by your comment at the beginning on dividend growth. And what I find interesting about use of cash analysis right now is nobody's talking about it. That has all my radar up. Why aren't we going to just see a continuation of use of cash, of dividend increase, and far more importantly, share buyback? People seem to like that.
Oh, yes, sure. People like the buybacks. They like the dividends. People who want to have income are looking for income sources, and that's where dividend plays work. They're also looking for inexpensive stocks, and that's where dividend plays work, because who needs dividend stocks, or who has needed them in the past few years when the FANG stocks, magnificent stocks, were all the rage, when people think that Microsoft is your bank? And who needed it necessarily when you could get money market rates over 5%? But guess what? If they start cutting interest rates, if the Fed starts cutting interest rates, that whatever $9-10 trillion that we have in money market funds, though we love them at Federated Hermes, will say, I don't know if maybe I want to find income at least in a more diversified way. And they will find that income in the beleaguered, nobody cares about, still fine fundamentals dividend plays.
What do you do with the big banks? We, I believe, have a banking day tomorrow, folks. We've got a lot of good coverage center on Shonali Bassick on that. JP Morgan, Citigroup, and the rest. Are they the ones to buy, or do you buy the value or value trap that's smaller banks?
Well, that's a really interesting question and important question. We're overweight at Federated Hermes on the financial sector, so we do like them. We agree that they're incredibly cheap. And as I've been watching your program before my time to come on, I saw your banking analyst pick JP Morgan as the #1 pick. That is a conservative pick. And so the chasm between the regional banks and the big money center banks is really, really wide. There again, an analyst can say, I don't need to throw the baby out with the bathwater. I can study these companies. I can find excellent regional banks that are unbelievably cheap and maybe even single-digit PE ratios. And that will be the important broadening that will give us a good, strong year this year.
At times last year, that gap got even bigger. Linda, thank you. It's good to hear from you. Linda Dissel there of Federated Hermes. TK, that analyst, Erica Nigerian, UBS, looking for a rocky time for some of the banking sector later this year and looking at JP Morgan for defense.
That's what we do. We're trying to get you sell-side analysts like Ms. Nigerian and Mr. Cassidy over at RBC, and I love Linda Dissel there. You know, very much like Megan was at Graper at Barclays yesterday.
Oh, she was awesome.
These are like grizzled pros folks taking a belief amid the cacophony of news flow right now. You may not agree with the belief, but boy, you listen to them to frame out why Linda Dissel has that view of optimism on the market.
We are 18 minutes away from inflation data in America. It is just around the corner. If you are just joining us, welcome to the program on TV and radio. This is Bloomberg Surveillance, and your equity market is positive by 0.15%. Yields are lower by 4 basis points, 398.66. It's EK. We're going to catch up with Dana Peterson of the Conference Board, reacting to the CPI data following those numbers. Mike McKee's going to break it down for us. We need to talk about the threat of higher inflation in our future as well, and a source for that potentially from the shipping problems in the Red Sea. We'll catch up with Bloomberg Intelligence in a couple of minutes' time.
Yeah, Lee Klasko to come up with this as well, and he's truly world-class on this. I'm not quite sure how boats in the Red Sea fold over to tractor-trailers on I-80 going out past Iowa, but the idea of logistics and transportation being upset is a wild card for this year.
Have you seen the move in AP Moller-Maersk? 2 months, 30%. They're looking for higher prices, potentially. That's what this market is here in TK. That's what the reaction is in the stock price. Are we going to see that in the kind of numbers we'll be looking at CPI? Not this time at 8:30, but maybe a few months down the road.
Well, yeah, it's a hockey stick up off the huge depreciation last year. But again, maybe that comes up to something we haven't talked about all day, which is China. I mean, I wonder how shipping folds into a misguess on a better than good China. That's not consensus, but it's out there. It's something people are talking about.
Lee Klasko of Bloomberg Intelligence coming up next on shipping stocks, absolutely surging in the past few months. In your equity market on the S&P 500, positive here by 0.15%. The data is just around the corner. CPI in America with a bond market, a yield on a 10-year around 4%, 398.66. Yields are lower by 4 basis points from New York City. This is Bloomberg.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Right now, the consumer is starting to feel a little bit better. Inflation is going to continue to come down. Wages and incomes are still rising. So there's a lot that is positive for households And it's a lot that's that is positive for businesses because interest rates are going to go down. So we do think that there is a chance that there will be upside surprises in the economy.
That is the very positive view, the outlook on the economy. Rabila Faruqi there, chief US economist at High Frequency Economics. Inflation data, the next stop, a catalyst for conversation in about 15 minutes time. That is just around a corner in America. The price action, the scores going into it, shaping up as follows. Pretty muted on equities, positive by 0.16% on the S&P. Yields are a little bit lower, down by 4 basis points, but still around 4%, Tom. 398.66.
In the old days, John, let's get right to this, folks, because this is too valuable for you on transportation and logistics. In the old days, John, we had paper sell-side reports. There wasn't the internet, there wasn't PDF files, and you would look at a Prudential report from Lee Klaskow and you'd say, wow, does he know what he's talking about? This guy has devoted 30 years plus to the idea of logistics in America, and all of a sudden he's an expert on the Red Sea as well. Lee Klaskow, senior logistics analyst for Bloomberg Intelligence. ABN AMRO years ago, Prudential, the blue and white, to be like, wow, this guy knows what he's talking about. What's the distinction, Lee, that's not in the media right now on this Red Sea mess? In logistics, what's the thing you need to tell people?
Well, I think that most people should take to heart that this is probably a short-term phenomena and not a long-term structural change to rates. It's obviously been very disruptive to supply chains as ships have to bypass the Suez Canal and go around Africa. That adds 10 to 12 days, and that is absorbing a lot of excess capacity that's in the marketplace. The amount of capacity that's probably was the loosest was the container liner industry, and you're seeing, really the best, increase in rates in that market. Since they bottomed in mid-October, they're up around 165%. And so that's a pretty high number, but people have to also remember, yes, it may be a little inflationary, but rates are down about 70 to 80% since their highs during the pandemic.
Right.
They were depressed before. Even though rates have gone up considerably, companies like Maersk or Zim or Hapag-Lloyd, they may not make money in the first quarter, even with the high rates, because the rates are higher, but they're just starting to move above break-even levels for a lot of these carriers.
Lee, we talked to you a number of times during the pandemic when this was nuts, including imports into California from the Asia and all the upset of China and the Pacific Rim. Are we back to normal?
When it comes to the North American supply chain, I think we are very close to normal. I think the rails have to do a little better when it comes to service. They've made some drastic improvements since the onset of the pandemic, when they were caught flat-footed and they furloughed way too many people, and it took a long time for them to rehire those folks back because a lot of them did not want to come back to work. But outside of that, I think we are back to normal. I think the trucking market, there's a lot of capacity out there, and that is keeping truckload rates pretty depressed. But one of the knock-on effects of the Red Sea, at least when it comes to North America, is we could see an increase of traffic coming into the West Coast because the East Coast is just either too expensive or taking too long, and then railroads will ship freight or containers from the port of LA or Long Beach or Port of Prince Rupert up in Canada to the population centers in the East. And that would benefit like the Union Pacifics, the Burlington Northerns, and also the intermodal providers like J.B. Hunt and Schneider.
Lee, as you know, that's not just because of what's happening in the Red Sea and potentially the Suez Canal. It's the Panama Canal as well. The water levels are pretty low. Lee, I'm just wondering how busy those rails are going to be over the next few months and how busy the West Coast is going to be, given that too.
Yeah, I mean, what's going on both canals has obviously been extremely disruptive. In the Panama Canal, as you mentioned, when that comes to a conclusion, that's, in my mind, a bigger unknown because we don't know when Mother Nature is going to, bless the region with rain. So what that is limiting is the number of ships that can go through the Panama Canal and actually how much freight a particular ship can carry because of the limits on the levels of the water. And so that is also changing the way people are shipping things. They're maybe, instead of going through the Panama Canal, for delivery into the Gulf or the southeastern United States, maybe they're moving stuff again into the West Coast ports, which would be really good for the West Coast ports because, they've lost market share during the pandemic when congestion was at its highest. So you could see them starting to win back some of that share. And, one of the other railroads, Canadian Pacific, Kansas City, now, they own a railroad that is a land bridge in Panama, and, they're probably benefiting incrementally from the lower water levels as shippers are looking maybe to use that land bridge to move the containers from the Pacific to the Atlantic.
This speaks to what Tom asked you, and I think we have to put these two stories together. Are you comfortable with the capacity that we have on the West Coast to deal with this?
Yeah, I think we're not nearly where we were during the pandemic. What really will depend is how long the issues in the Suez Canal last, because it's changing the schedules. So when a ship was expected to come 7 days and everyone prepared for it to come in 7 days, and if that's all of a sudden 14 days, you have to readjust the schedules. Mm-hmm. So you might see some ships waiting a little bit, but you're not going to see the craziness that we saw when there were over 100 ships, outside of LA Long Beach waiting just to dock to unload their freight. But it definitely will be a little disruptive. And hey, if this ends in a couple of months, I think it'll be more or less a flash in the pan.
Lee, off topic, but critical over your 30 years of excellence. When we look at the revolution of logistics in our delivery, FedEx, Amazon, and the rest of it, we had a next day experiment. Is next day shipping sort of done because it proved to be a lot harder to do than we expected?
I don't think so. I think it's a premium product, and therefore it probably deserves a premium price. If you really need that Amazon order to come the next day, you might be willing to pay for it. Or if you're looking for, somebody that maybe is not on Amazon, if you're looking for that next day, you're willing to pay for it. But I think what we're seeing is consumers are more willing to say, well, I don't need it tomorrow. I can wait 3 days. And that is something that we're seeing in the numbers for FedEx and UPS. When they report, you see a negative mix shift to, more economic services, which carry lower fees and therefore reduces their overall revenue per shipment. So I think that, it's not over, but it's maybe, it's really going to be pigeonholed to be more of a premium as opposed to the norm.
I just wanted to squeeze this in. You alluded to it earlier in the conversation. Just quickly, how durable are these tailwinds? We've seen these big stock moves in the last 2 months, particularly on the likes of AP, Moller Maersk. Do you think this is durable?
No, because the reality is that, listen, I don't know when the Red Sea crisis is going to end. It really depends on the coalition and how active they go after the Houthis. It doesn't seem like they've done much so far. They need to do a lot more. That being said, once it does come to an end, there are structural issues within the container liner market. Supply growth is supposed to outpace demand growth by a significant margin over the next 2 years. And that's going to bring rates back to those depressed levels that we saw, maybe not in mid-October, but much lower levels than we saw today. It's a little different for the tanker and the dry bulk market. Those supply-demand fundamentals are in much better shape.
Lee, this was awesome. Let's do this again soon. Lee Klasko there of Bloomberg Intelligence. I can tell you, Tom, if the Federal Reserve wanted to be short one story right now, it's this one right here. This is not one that they want to stick around.
Long ago and far away, Kenneth Rogoff said to me quietly, off mic, off camera, there's a huge underestimation of the ease of our logistics, our modern logistics. Sometimes I get a DHL from Europe faster than I do from Dallas. What is that about?
It's kind of strange, isn't it?
It's kind of strange.
I know.
But we take it for granted. And the answer is now we do not with our military in harm's way in the Red Sea.
Without a doubt. We don't take Mike McKee for granted. I can see him at the corner of my eye. He's here to break down inflation data. CPI in America up next. Bond yields lower by 5 basis points, 398. Equities positive. Your data is just around the corner.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The inflation data in America about 20 seconds away. The scores going into it look like this on the S&P 500. Equity futures positive by 0.2%. A little lift in this equity market. In the bond market, we are rallying. We're down 3 or 4 basis points on a 2-year to 432. On a 10-year yield, we are lower by 5 basis points to about 398. With the economic data, CPI in America, is Michael McKee.
Well, it looks like we had a little hotter than we expected. Inflation during the month of December up 0.3%. The forecast was for a 0.2 gain, pushes the year-over-year number up to 3.4% from 3.1% in November. That's not what the Fed or the markets want to see. However, the core rate comes in at 0.3 as expected, which pushes down the year-over-year core number to 3.9% from 4%. So it's basically what we're seeing here is a little bit worse headline and as expected core, and the core is going to matter more than anything else. Index for shelter is what the BLS says contributed most of the rise in December. Energy rose, increases in the electricity index and the gasoline index, which is a bit of a surprise. So I'll look at the rest of this breakdown here, guys, and you can look at whether the market is freaking out over this.
We've got a move, not a freak out. We're negative by, let's call it 0.10% on the S&P 500, 0.1% on the S&P. We're negative on the NASDAQ by, let's say, 0.03%. But the bottom line is we are off the highs of the session. Similar move in the bond market. So yields were lower. Now they're higher at the front end by 2 basis points to 4.38. In foreign exchange, the euro turning around. The euro was positive against the dollar. That currency pair is now negative by 0.15%. 109.56 on the euro against the dollar. Mike McKee, it's not just CPI. Got to say jobless claims.
Jobless claims, well. They continue to be what they were, 202,000. That is down 1,000 from the revised 203 the week before. But at this point, we're still dealing with holiday weeks and holiday adjustments, and that's always an issue. So it does tell you that the labor market is still tight, but we can't put a lot of faith in the exact number. Continuing claims, 1,834,000. That's down from 1,868,000. So a tight labor market.
Yeah.
Headline prices up a little bit. Core prices on a year-over-year basis going down.
I wish you could see McKee as he plows through this data, folks. It's years and years of experience. Mike, I'm not doing that. I got the cliff notes here. And the answer is I'm seeing an owner's equivalent rent, blah, 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 month over month, numbers you follow, up 6.3% year over year. Now, we'll have that come out here in a couple hours and see what housing is doing, rental, and all the rest. But are we underestimating that if there's already rates coming down, that maybe there's a rekindling housing boom out there? Is that an uncertainty?
There has been a suggestion that that could be happening, but that would be too early to get into the CPI right now. It wouldn't show up. We have seen ongoing strength in rents, which has been a reason for seeing ongoing strength in the housing numbers. But at this point, it's more just the fact that housing prices have not moved down very quickly. Here's the rent number. Rent of shelter up 0.3. I'm sorry, up at this point 0.4 after 0.3 the prior month. So rent of shelter, rent goes up, and then owner's equivalent rent is up 0.4 after is up rather 0.5. I knew it was 0.5. I said 4. I don't know why. After 0.4. So we saw the housing numbers go up, and that did not help. Yeah, I'm feeling I'm under.
Hey, Mike, I'm with you. It's like it's January 11th, and it feels like the longest month ever already.
John Farrow, are you surprised at the lack of movement in the bond market? I'm sort of surprised by that.
Not really. It's all incremental stuff. I'm not sure whether this is really going to shift the debate for the Federal Reserve, Mike McKee. You're going to catch up with the RevolVesta a little bit later.
The interesting thing is, last week we had a very similar result in Europe, where the headline went up and the core went down, and when that happened, European markets, futures markets, sort of freaked out a little bit and took away a number of rate cuts and pushed back the timing of rate cuts for the ECB. Some of that's come back now, but it looks like U.S. futures traders have learned a lesson.
You're going to ask Loretta Mester if she retires from Cleveland, is she going to become a football coach in the NFL? There's a lot of vacancies.
A lot of vacancies in the NFL. There's also a big one in Alabama. So if she's looking for some warmer weather, but she's originally from Philadelphia, and well, we'll see.
And $11 million, Mike McKee, like real money.
Yeah,
to go and coach Bama.
Yeah, 11 million or so a year. I don't think people will get 11 million because that was a guy who won 7 national championships. But you know, figure that into the Atlanta Fed wage tracker.
Football coach inflation that we see.
This is the job changers part where we see if you get more money for changing your job.
Stay with Mike McKee through the morning on Bloomberg Radio and Bloomberg Television. He'll go beneath the headline data. Really important stuff. I'm looking, first read for me will be David Rosenberg up in Toronto. We'll see what he says as well. Right now, Dana Peterson joins us, chief economist at the Conference Board. To the heritage of the Conference Board, Dana, is there inflation that will affect corporations in this report, or what your guesstimate is for tomorrow's PPI?
Well, CEOs are already complaining about inflation. They're saying the cost of doing business is higher, from wage increases to higher interest rates. All of it's really weighing on CEOs right now. So I think some of this probably will feed through to the CPI and the PCE over time.
What will it do to Fed policy? I mean, it's an unfair question. Mike's only on page 6 of a 42-page report. But Dana Peterson, do you see enough of a movement here to adjust the parlor game of March and beyond to June?
Well, we think that the Fed probably won't start cutting rates until around June. And the key thing will be the course of inflation. The good news is that core inflation is still slowing, but the Fed also cares about the headline. And certainly when we look in the core, if home prices are still rising month on month, that doesn't bode well for year on year. But the good news is that we are seeing some cooling in wage inflation overall. And when you look at home prices, or at least the existing home prices year on year, they're slowing, and that's showing up certainly in the rental components of both the CPI and the PCE.
Dana, can we get a little bit more detail there? Just how high or low is the bar, do you think, to reduce interest rates at the Federal Reserve? And is it because you think it takes longer to get to that bar, or ultimately it's a bit higher than this market thinks it is?
Well, I think the bar really is inflation, but it's also going to be the labor market. Does the labor market continue to cool? If you take away government, leisure and hospitality, and healthcare, you see no gains in employment. So once those three industries run out of steam, what do you have? And also the economy in general. Does the consumer stop spending and really slow? So I think if the economy slows a lot, labor market continues to slow, and inflation is headed back to the 2% target, the Fed will feel comfortable with cutting interest rates. But it may not be in March. It may be a little bit later this year, again around mid-year.
Is that when we'd expect to see it in jobless claims as well? Because, Dana, it's not just about CPI this morning. We've got jobless claims at 202,000. It's just absolutely incredible. When would you expect to see that start to inflect higher?
Sure. Well, the reason why initial jobless claims are so low is that our own data say that CEOs of large companies are not looking to let people go. They're hoarding workers, holding on to people. But certainly when people are let go, it's taking them longer to find a job. So continuing claims are ticking up a little. And we do think that's going to show up more so in the unemployment rate.
Are you modeling out a wage growth that sustains above inflation And so America sees a legitimate, real wage growth?
Well, it is possible that wages will remain above 2%. Certainly when we look at the gains over the last few years, yes, they were really outsized. We are seeing slowing, but you do have some industries that wages are rising, certainly in construction, in particular non-residential construction, where there's a lot of impetus to build infrastructure and factories at home due to industrial policies. So you could see wages settle out at a rate that's above 2%.
I mean, I looked, Dana, at the inflation data, and I want to go back to it. You know, this used to be religion 30, even 40 years ago. PPI was just as important as CPI. That all went away. But in tomorrow's PPI report, I know it's rejiggered. McKee's explained it to me 3 times. I flunked the quiz, the McKee quiz, 3 times. Dana, final business inflation, is it legitimate?
Sure it is. Absolutely. It's everything that businesses are looking at, and certainly that includes transportation costs and which are a big thing, and also services, which are quite material. So even though the PPI is different now than it was, 10 years ago, it's still very relevant.
This ties, John, directly into what Linda Dissel said at Federated. It's about margins. And if you've got that inflation input down the income statement, what does it do? Now, forget about Apple and all that. In a real American company, I mean, what's it mean for margins? Church and Dwight, they make toothpaste.
Apple's not a real American company.
No, it's not a real American company. It's a luxury stock thing. But to the rest of America out there making 4% revenue growth, I'm sorry, margin erosion could be tangible.
Dana, this was brilliant. Thanks for your time to break this down with us. Dana Peterson there of the Conference Board on CPI data. Just ahead, Tom, PPI data coming up tomorrow morning. You mentioned that as well. Jobless claims out moments ago too. Jobless claims coming in at 202. Mike McKee still around the table with us. Mike, you've had a bit of time to chew over this. Your thoughts?
Yeah, we mentioned housing being the biggest contributor, but also gasoline prices were up 0.2, and that's a surprise after the declines that we have seen in the anticipation that we would see some declines. Also, used cars were up by 0.5%, which is totally the opposite of what was expected. We were looking for another, maybe smaller, but another decline in used car prices. Airfares also up after a big drop in November. So some of the areas that have been a problem all along are still contributing to higher inflation, and it's something to keep an eye on. Food prices up just 0.2. So that's the same as November. So if you look at overall gasoline prices, we did see a bit of a rise in part of December and then a decline again. It's been declining, and food prices down a little bit. I'm doing the Anne Marie part right now, that Joe Biden and the White House can maybe see some progress with the American people, because the things that the people see and think about inflation are down.
I can see you're up to page 14 of the 42 pages. Can you tell yet what service sector inflation is? You were hysterical 90 days ago about some index I never understood. Is there service sector inflation out there?
Well, I can look at service sector inflation here, and services, less energy services, were up 0.4 after a 0.5, so they dropped. Overall services dropped, and we can see what the core rate, the super core rate was by calling it up. That's the one you like, right? Yeah. That's the one that Jay Powell had talked about, and the super core is at 3.87% to do it in 3 digits, which is up from the prior month. So.
The key is 3 digits.
I know, it's impressive. Gifted. Mike, do you think Hertz dumping 20,000 EVs on the used car market is going to move the dial?
It could, but the question is, that's a lot of cars when you consider that the annual auto sales rate is somewhere around 15, 16 million, the annualized rate. So 20,000 in a month is a lot. But the question is, how many people are going to buy them?
I know.
And I don't know what the average EV price is in the used car market. So is Hertz going to be underselling to try to get rid of them? That would push prices down.
Does that fold through the used car market? Does that go through? You said
that'll go through the used car market because these have been used by Hertz. I think the problem is people did not want to drive EVs because they're not used to them. If you have one, you maybe put a charger in your house and you know how to do it and where the charging things are. But to rent one, I know I've heard from people who got EV rentals, and they're like, what do I do?
Get the anxiety. Get to the airport in a city you've never been to before, Tom.
I don't.
Got to take a journey. You can see why that makes sense. And by the way they're going to sell this, I understand, Mike, they started last month. They're going to spread it out through 2024. So, Tom, it's going to take a while to get rid of this stuff.
Somebody was giving me grief about this. I mean, today, I don't know if you saw this, Mike, I've made a list. I'm a Bitcoin idiot, is what I'm called out there. Maybe I'm an EV idiot,
Can you share that list with me? I have not seen that list.
I'll show it to you.
Where do you rank on this list?
I'm way down. I'm
okay.
I'm like,
All right,
like bottom run.
But I feel like you're proud of being on that list.
Some would say I'm an EV idiot, but I'm not. John, I will never forget getting in a London cab at Heathrow, and it was one of these new fancy EVs. Blown away. Absolutely blown away.
Smooth, nice and quiet.
Just blown away. It was better than the Bentley.
Conversation's going to continue. I'm not sure I go that far. Craig Trudell of Hertz, on Hertz, of Bloomberg. Up next, equities, just a little negative.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Base case is that the current restrictive stance in monetary policy will continue to restore balance and bring inflation back to our 2% longer run goal. I'll expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals.
Was New York Fed President John Williams speaking on the U.S. economy and the outlook for the year ahead. From New York City this morning, good morning. Your equity market shaping up as follows on the S&P 500. Unchanged, TK, following that slightly hotter than expected CPI print about 16 minutes ago. Yields basically unchanged on a 10-year as well. Off the lows, though, so we're back to about 4% on a 10-year. On a 2-year, unchanged on the session. Also off the lows at a session on a yield, 436. So, Tom, initially, equity sold off, yields climbed, the dollar was stronger. We've erased much of that move in the last 15 minutes or so.
I'm going to call it a jumble, and I guess I want to say it awaits for tomorrow's PPI, but I'm not sure the market's riveted to PPI. And I guess it just, once again, John, it's just further data. And guess what? There's going to be a lot of microanalysis, including the annualized ballet in that. But there it is, just staggering into 2024 with the real estate. John, it's like used cars. All of a sudden, Teslas fold into used cars. What do? You go up to, there's some famous used car auction in the northwest of the United States, Minnesota or wherever, and there's going to be 4,000 Teslas on the lot.
Tom, look, this is a serious thing. This is a reality check. This is another warning from an American company saying we tried to do this too quickly. The consumer demand is not there. And by the way, I'll throw this in as well. It's not just that the consumer demand is not there. This is costing us a lot of money to carry these cars. A lot of money compared to the internal combustion engine vehicles.
I haven't come up with a cute phrase for Davos yet, but the bottom line is that's what's new at Davos this year, is every single fancy executive at Davos has to worry about cost of carry within whatever their business is. I mean, it's a changed world.
Hertz is negative by 4% in the pre-market. It's interesting that Tesla in the pre-market is only down by 0.5%. The bulk of the vehicles in that fleet that they had, the EVs at Hertz, were Teslas, Tom. And if it's Hertz and the other car rental companies facing a similar problem, signaling that lack of consumer demand,
well, how does
you wonder where it shifts from here.
react to this?
I think that's the right question.
Yeah.
Because the one we've been asking, and Dan Ives of Wedbush sat in that chair, what, a month ago, a few weeks ago, and he said, are we finding out, do we just want Teslas and not EVs? Where does it leave GM? Where does it leave Ford? If you ask management, and we touched on this earlier, if you ask them, is this a shift in execution or strategy, they will always say execution. And I'm trying to work out, Tom, when we actually get a shift in strategy, when they start to reconsider the ultimate destination for this, because this government is clear about where they want things to go. We know the objective. What we're finding out is we can't get there as fast as they'd like us to. When do we start to question the ultimate objective?
We don't have time here based on the breaking news, but what does the next government say if it's a second-term President Trump? I mean, there's going to be a whole different view, and that goes to the politics of EV up to the election. That's off story today, but nevertheless there it is as well. Why don't you bring in our next guest, because he's the only one of us that has a driver's license.
Craig Trudell, that's a good point, of Bloomberg. Craig, great to catch up, sir. I guess just your initial reaction to this one as it dropped in the last hour or so.
I mean, it's just fascinating to me because I think back to when Hertz announced that they were going to buy a ton of Teslas. This was 2021. We were still in kind of, the meme stock, era. It was very clearly, to me, it seemed like a play on the part of, just bankrupt Hertz to really generate interest in the company and interest in their strategy going forward. And it made Tesla a $1 trillion company. And, it was soon thereafter that, it was about a year ago now that, we saw in the regulatory filings that Hertz was actually buying a whole lot fewer Teslas than they initially announced, and even falling well short of their plans for the number of Teslas that they were going to purchase. They've really sort of taken a bath on those purchases. It can't help that Elon Musk has cut price so much, and that's got to be a big factor here.
Craig, unfair to you, but let's try to go there. What's a new Tesla cost? What's a used Tesla cost now? And what's it going to cost in 90 days?
Yeah, I think if we think about, the cheapest Tesla you can get your hands on, right, a Model 3. I mean, this is a car that, was supposed to, out of the gate, cost $35,000. The company is now fairly close to that in terms of, how much you can pay for a new one. And that moved down dramatically last year. This is a company that, just repeatedly was cutting price to try and, keep growth going. It was effective in helping the company to continue to increase volume, but they really took it on the chin in terms of margin, and it really burned Hertz. And over here in Europe as well, you've heard rental companies gripe about what the price cuts have done, from a depreciation standpoint for their fleet.
On a $35,000 value, then what's that used car going to be in 90 days?
We're seeing the 90-day question is a little bit tricky to answer, but I will say that one of the things that we saw, just as Hertz has started to list these cars on its website, is that you can, get your hands on one for like $16,000. And so, this is pretty substantial depreciation for a company that only was buying, Teslas just in the last couple of years.
Craig, I want your view on this. Tom and I have been talking about it over the last hour or so, ever since this news came out, but I think it's been a topic of conversation now for months. This is another reality check. When you speak to the manufacturers, the big automakers in this country, they talk about a change of execution, not ultimate strategy. I think they all agree on the ultimate destination, the objectives of this administration and how it's going to support them. At what point do we start to question the ultimate destination? Where is this industry going?
I think if we take a step back and think about this from a global perspective, we're not necessarily seeing this, sort of disastrous result in China or over here in Europe. So I do think that this is a bit of a U.S.-specific phenomenon where you've had a really dominant player in Tesla that was pushing for years. And, maybe, the fact that they pushed on a string to some degree in the U.S. just in the last year and a half or so, And we've seen this really sort of, cyclical change in the auto industry, which we've seen, over a long period where you see companies kind of, boom and bust quickly. The question is whether or not this is a U.S.-specific and Tesla-driven phenomenon. It seems to be the case that, this company that's been very successful maybe, got over its skis to some degree.
I had a blistering conversation with Mari Barra. How did GM and Ford react to today's bombshell announcement? John, what's a pickup truck cost? Like $150,000?
Well, an F-150 Lightning.
Yeah, whatever.
If you deck it out, it's going to be pretty expensive.
Craig, why can't we make a $38,000 GM whatever to compete with the Elon Musk company?
I think the fact that Musk has been at this for so long, we're seeing, to use his phrase, production hell on the part of GM and Ford, where, these are companies that have a long history of making combustion engine cars. They don't have nearly as long a history, of course, making electric vehicles. And they and their battery partners are really struggling to scale up the way that we saw Tesla have challenges with the Model 3 years back. And so you've seen Tesla jump out to this big lead, it's been a long slog to bring costs down. We've seen, similarly in China, a ton of investment, a lot of losses, a lot of, negative headlines for many years for some of the companies in China, where, we've seen Tesla and BYD really emerge as the very clear 1 and 2, but it hasn't been a sort of, clean story of all as well.
Craig, thank you, sir, for jumping in front of a camera in London. We appreciate it. Craig Trudeau there of Bloomberg out of London on the latest with Hertz, needing to sell 20,000 EVs and replace some of them with internal combustion vehicles. The stock is down by about 3.85%. Tom, the standout from that conversation, just how unique some of these issues are to this country. That these are headlines we're seeing in America and maybe not seeing them in the same way in Europe and elsewhere.
We're not seeing them there because are we bringing in Chinese EVs into America? And that's a huge distinction for German manufacturing America. I want to be accurate here. We try to be accurate on surveillance. John, it's the LEVC TX electric taxi. Mayor Adams, can you just bring them to New York? That's all I want, John, is some fancy 5 or 7 year pay structure for our cab drivers and cab companies to bring the best cab I've ever sat in my life.
You love that cab, don't you? What is it you like about it? Is it the ceiling?
It's got the weight. Yeah, the ceiling.
Sit in it? Is that what it's really about?
Unlike here, do it again. I can't.
You want me to pull you up?
Unlike the Tesla.
Is that where you're at?
Again, but the bottom line is John, it's just done right, and that's what we need in our transportation in America.
This was nice. We should do it again.
Yeah, we should.
I'll see you tomorrow.
Yeah, we'll do it tomorrow.
Live from Bloomberg TV and Bloomberg Radio from New York City for our audience worldwide.
Show up.
CPI behind us, bank earnings coming up tomorrow from New York City. This is Bloomberg.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities
are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
From New York City, for our viewers worldwide, I'm Manus Granny in for Jonathan Farrow. Risk hits a pause button on the disinflation story, getting harder from here. Stocks drop incrementally. Countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up on the show, the US CPI coming in hotter than expected, jeopardizing the chances of that March rate cut. US PPI and big bank earnings will hit the tape over the next 24 hours. We begin with the big issue, inflation in the USA.
Every CPI matters. It's an important number.
Critically important here.
Very influential in that market pricing on rates.
The Fed has a tough job of threading a needle.
If inflation keeps falling,
it's important for the Fed to adjust their policy stance.
They will deliver those cuts, probably starting relatively soon.
The market is dead set on believing the Fed is going to ease.
Inflation is coming down.
It's going to continue to come down.
On a glide path lower.
The risk would be those rate cuts get priced out because inflation kind of turns higher.
We are not out of the woods when it comes to battling inflation.
You're going to have these fits and starts.
We're in this immaculate disinflation, but it's not going to be a straight line down.
Watch inflation and watch for how inflation behaves.
The road to heaven or hell is paved with good intentions. That's what I'm told. Let's discuss the road to disinflation. PGIM's Robert Tipp, Morgan Stanley's Matt Hornbach. Gentlemen, good morning. A little bit harder than the market had expected, but does it just say to me the road to immaculate disinflation might just be a little bit bumpy, and I might need to just review my March threading of the needle for 25 basis point cut. Good morning. Matt, to you first of all.
That's exactly, good morning, and thanks for having me on. That's exactly what our economists have been looking for, is a bumpier path over the first 3 to 4 months of 2024. So we're expecting the 6-month annualized rate of core inflation to move up almost 100 basis points as we make our way through the first quarter of the year, which we do think will push back the timing of the Fed's first interest rate cut.
And okay, that's you setting out your stall there. Let's take it across. And Robert, in terms of this narrative, stock's a little bit lower. This is just about a re-involving and a re-engaging with the pause, isn't it?
Right. It's a re-engaging of adult mentality. The markets had a rocketing run here. Huge drop in interest rates, big pop in stock prices as we wound down the year, and people expecting these interest rate cuts, which eventually will come. We're past the peak in rates, and that's all well and good. But about that road of disinflation, I think the main thing to keep in mind is it's not a sprint. This is a marathon. and especially this time, because the Fed has laid out that they don't want to make a mistake. That by itself means they're going to have to be patient. They're going to have to wait a long time to make sure they have evidence, number one. Number two, the evidence, the data is bouncy. Every few months, the different series of inflation have had big bumps to the upside and then troughs. And so that enables people to run with their imagination and make a case that things are going to seriously reaccelerate or that they're going way below target. So I think it's a pretty smooth path. It's going to be a wide trading range. We've had a big run, and now the markets are correcting based on some short-term disappointment here.
Yeah, and one could say that is a fairly natural thing to do. Let's dig under the hood. Mike McKee has had time to read some of the pages of this inflation report. So, Mike, where do you want to go? Supercore, housing? Tell me what it is that has caught your eye on this number.
Well, let's talk about what moved. And of course, you already gave the numbers for the headline there, 03 on the month, 3.4, and the core 03 and 3.9. Increasing housing, that was the biggest change because, of course, housing has the biggest weight in the CPI, and it was up 0.5 after 0.4 the months before. Surprisingly, gasoline, after a number of months of decline, was up by 0.2. Airfares rose, and car insurance, this has been one that has been rising on a kind of steady basis over the past year. Car insurance up 1.5%. From what I'm told, it's basically people with their new EVs and things like that. It just costs more to fix that stuff when something goes wrong. Decreasing natural gas, that's going to change next week when the polar vortex hits the United States. Furniture, and oddly enough, car insurance may be more expensive, but car repair was a little bit less expensive. Let's take a look at the housing contributions here. Now, you break down housing into rent and owner's equivalent rent, and then there's a small category, lodging away from home. And you can see that the owner's equivalent rent, the purple there, is the big mover for the month, and it helped push up housing costs overall. The blue is the rent, and rent has stayed steadily high. It hasn't come down. That has surprised me. Not as much hotel price problems as we had. So where does it leave us in terms of the Fed? Well, we've seen a sort of decline over the past month or so, and you can see here a couple months worth in terms of the idea of a March rate cut. While we've seen an increase in the May rate cut. Today, you can see the boxes there show where we were beforehand and where we are now. And at this point, we have a slight increase in where the market thinks the Fed will go in March and May, but not enough to say that this has changed the game. Basically, makes the case for higher for longer. Not going to affect the Fed on January 31st. And then the question is what happens in March and what happens in May. We'll have a lot more data before then.
Okay, well, I'm looking forward to your conversation with Loretta Messer a little bit later on. But let's reflect. Just a short time ago, the New York Fed President, John Williams, weighed in on the path ahead.
My base case is that the current restrictive stance in monetary policy will continue to restore balance and bring inflation back to our 2% longer run goal. I'll expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals.
Well, Robert Tipp and Matt Hornbeck are with me. Listening to Williams, and I listen to the New York Fed, as probably most of the bond market does, more than it listens to anybody else. I was corrected this morning by Berenberg Bank. I said the market didn't listen enough to the pushback on higher for longer. And Berenberg chastised me and they said, no, you're misunderstanding the point. You need to understand where the new neutral rate is in a post-0% world and in a post-COVID world. So with that in mind, higher for longer, what does it mean for you, first of all, Matt?
Well, I think, I mean, certainly we need to think about what these terms mean. And, you know, when it comes to higher for longer, we think the Fed looks at this from a real interest rate perspective, a real monetary policy stance perspective. And so in this world where you're talking about real restriction, then you need to understand where monetary policy could go based on where inflation may go. And if inflation does continue to move back towards the Fed's 2% target later this year, which is what our economists expect, then you can also expect the Fed to begin to maintain restrictive policy, but still be lowering the nominal interest rate. So higher for longer really should be viewed through a real interest rate lens as opposed to a nominal monetary policy lens.
Well, Robert, let's take that across to you, because I like what you said, which is pause, pivot, and party on. That's my kind of weekend, which is, pause, have a sleep on a Friday, and then get going again. So to do that, what number of cuts do you need to have in the pipe to deliver that party on mode? Is it the 6 that the market is baying for, or is it the 3 that you're being promised by the Fed? Not promised, indicated by the Fed?
Right. Well, I think that the pivot has happened. They have hesitated on this. They were in Matt's world, which is their world, supposedly, of the real rate, that they were going to cut nominal interest rates as inflation came down. And as you pointed out, what is neutral? And they don't know what neutral is, and they know, and they will admit they don't know. Nobody knows. But their best guess is that it's not 5.3 relative to a 3.5% inflation rate. That's a couple percent real based on one of the higher indicators of where inflation is right now. They think it's more like 0.5%, 1%, or maybe even 0. So they're very restrictive right now. So to President Williams' comment there, we need to be higher for longer in real space doesn't preclude cutting nominal rates. Cutting nominal rates keeps the vibe, the party vibe, alive in the market.
So like what you say there, which is cutting, the nuance is about the real rate, and that could allow them to do 100 basis points. That gives you 100, in theory, 100 basis points of real rates, and that could deliver a 1995 soft landing environment. Is that what I take away from this?
I think the underlying pace of growth right now is slower than the late 90s, but otherwise, by comparison, this is a better cycle in the sense that growth is very smooth. They have hiked more cautiously this time. They slowed down early enough to get good information. Last time they were hiking at an accelerating rate over a period of just under a year. And they had a pretty decent give back in economic momentum in 1995 that I think shocked them. Everything worked out fine. But there was also a lot of turbulence caused by that, starting with Mexico and the crisis at the end of 94 there. So I think this is a lot less tumultuous. I think it's very similar, though, in the sense that in 94, most of those rate hikes, they stuck. It was a very slow, moderate process after that. And right now, we have had 500 basis points of rate cuts. 500 basis points of rate hikes, right? We were down at 0. Now we're over 5. This is going to be a very slow cutting cycle by comparison. We came up, on the elevator. We're going to go down on the escalator or the stairs.
I got you.
But I think that's going to be a good environment for the market. There's going to be a lot of emotional swings here. This 4% could be kind of a central tendency, though, for the 10-year. And that could be very productive, both for returns in the long run, but also as a trading environment.
Okay, well, let's turn the talk to trade, or certainly positioning. Matt, you are neutral on duration. What goes through my mind, and a lot of people on the IB have said to me, they talked about term premium. Do you think there's enough term premium? And I'm sort of answering your question on your behalf. I take it then you don't think there's enough term premium for you to take an acceptable level of duration?
Well, on a tactical investment horizon, yes, we think that's right. But on a more strategic horizon, we think there's plenty of term premium in the bond market today. Our tactical neutral stance is a stance. Oftentimes people think about a neutral position as not taking risk. I mean, there's an opportunity cost to every decision that you make in markets, and being on the sidelines does present a cost. So we are taking a view to be tactically neutral, but the reason for that is not because there's not enough term premium in the market. The reason is because we do expect a little bump up in inflation, and so we would be looking to buy any rise in yields as we make our way through the next couple of months.
Robert, let me take that across to you. You're still in the strategic buy zone for bonds. I mean, are you happy to pick up 4%, or do you want to see a further backup in yield, before you're tempted in on duration?
Well, I think the market is at a healthy point here, and to that, Matt is neutral duration. And the posture here that makes a lot of sense is to be relatively neutral, but it's going to be a trading range environment. And I think in Morgan Stanley research and for us, there are a lot of opportunities inside the yield curve here in terms of shape for adding value through roll down strategies and expecting changes in the slope of the curve. On the term structure point, I think that we have been in a world for about the last 5 years that we're going to stay in, where the investors that are really driving the market have a long-term perspective. And so in that sense, this will be, I believe, like the 2019 cycle, where after the rate hikes of 2018, after that ended, the curve rallied a good deal and then maintained a pretty tight relationship between the expected Fed funds rate and the 10-year. And we're down at that kind of a relationship right now. So I think the expectation that the Fed's going to cut a couple hundred interest rates, 10 years are around 4%, centered around that forward expectation for the Fed. I think we're going to be range bound around that kind of a relationship. That's going to be enough term structure premium or slope, really, to put it more plainly for this cycle.
Okay. Hold those thoughts, gentlemen. We'll be back. Robert Tipp and Matt Hornbach, my guests this morning, on the very latest CPI data. Let's look under the hood, look at the stocks that are moving. Abigail Doolittle is side by side with me here.
Well, Manus, futures are pointing down slightly after that somewhat hot CPI print for the month of December. Starting off with the shares of Tesla right now, they are pre-market lows or thereabouts, down 1.4% on that warm CPI print. They also just told their staff that all U.S. production workers are getting a pay raise. Bank of America down about 1%. As yields and the yield curves are higher. One of the big banks, of course, is reporting tomorrow, Bank of America, along with JP Morgan and Citigroup, maybe some nerves into that. But take a look at Coinbase, Manus, up 4.6%. This, of course, after that landmark decision by the SEC to allow ETFs to directly buy Bitcoin. It's being called by many a significant milestone.
Okay, Abby, we'll see you a little bit later on. We'll break down some of those sectors. Coming up on the show, GOP candidates, they square off in Iowa.
It's time we have an accountant in the White House. We have to have someone that respects taxpayer dollars.
We don't need an accountant in the White House. We need a leader in the White House, and that's what I would bring.
Nikki Haley and Ron DeSantis going on the attack before the Iowa caucuses. That conversation next on Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
it's time we have an accountant in the White House. We have to have someone that respects taxpayer dollars.
We don't need an accountant in the White House. We need a leader in the White House, and that's what I would bring.
If he can't handle the financial parts of a campaign, how's he going to handle the economy when it comes to the White House?
The American dream is slipping away. People are working hard. They're getting the most out of their God-given ability. They're doing everything right, and they're falling further and further behind.
We need to start cutting spending in D.C. We have to go back to pre-COVID levels. That's why I'll veto any spending bill that doesn't take us back to pre-COVID levels.
Here's the thing. We need to fly a flag of bold colors, carrying the banner of putting the American people first, not the pale pastels of the warmed-over corporatism of people like Nikki Haley.
GOP candidates Ron DeSantis, Nikki Haley battling for the second place in the Iowa debate, slamming one another's economic policies, taking shots at Bidenomics. This CPI number coming in just a smidge hotter than estimated, putting the pressure on the president as he pushes his economic agenda amid worsening poll numbers. You've got the latest CBS YouGov poll showing 64% of Americans disapprove of his handling of the economy. Bloomberg's Katie Lyons joins me now for her assessment of the chunk-biting debate. Kaylee, good morning.
Good morning, Manus. I mean, Nikki Haley and Ron DeSantis spent more time throwing barbs at each other than they did, frankly, at the current president or the former one who remains the frontrunner in the GOP primary. But they did get into the issue of the economy very much so, both pointing to higher inflation, putting pressure on American families and voters, but also on the high debt levels. Both of them did point out in their few swings at Trump the idea that he added $8 trillion to the deficit. And as we just heard there, Nikki Haley, when asked what she would do to address the economy, said she would cut levels of spending and borrowing, would veto any bill that didn't bring spending below pre-COVID levels. Also said she would get rid of the federal gas and diesel tax, while Ron DeSantis talked about the idea of a flat tax across the board, also unleashing American energy production in order to get inflation down. But the fact remains, man, is that both of these two are competing for second place right now, as Trump far and away is the frontrunner in Iowa, which of course comes up on Monday, and generally right now, and they have to get through him and to get to an actual general election with President Biden as the Democratic nominee. Now, on the subject of President Biden, the numbers today heading in the wrong direction for this administration, which has been touting inflation and price pressures heading lower. And even as they have been heading in what has been consistently the right direction, he is struggling to get actual credit for that in polling. You mentioned just the latest poll, but it is consistent across the board that he really struggles with approval on the economy front, which is why the president has increasingly turned his messaging from Bidenomics more so to the threat of democracy that he says former President Trump presents to the American people. That really is how he's been leaning. We haven't yet gotten a statement out of the White House on today's figures, but I would imagine they're still going to stress that prices are lower than they were or price pressures rather, are coming down compared to where they were a year or two ago, Manus.
Yeah, well, it's certainly about the cost of the basket when you go into the store, Kaylee, and the gas at the pump. Kaylee Lyons, thank you very much. Robert Tipp and Matt Hornbach are my guests this morning. Gentlemen, I'm not going to ask you what you thought of the debate or who you think is going to be in the White House, but the way the odds look at the moment, Trump is out front ahead of his pack and his peers. From a market's perspective, how early will we begin to see? If Trump is on the ticket, what will that mean for the fiscal narrative to the bond market? Matt, to you first.
Well, as they say, 2 weeks is a lifetime in politics, so I don't think that markets are going to be particularly concerned about who ends up being the nominee for the Republican Party until it's actually in hand. Mm-hmm. But nevertheless, I do think that as we make our way later into the year, there is going to be focus on how the upcoming election and, importantly, the uncertainty around the election outcome, whatever it may be, could impact the confidence of consumers and the business investment plans of corporate America. You know, generally speaking, when we go into a very uncertain election cycle, you typically see businesses pull back, consumers pull back. They wait until they have clarity about the outcome of the election. And then we see a boost to activity after the election is out of the way and the results are known. So I do think that the election does present some interesting risks to the economy as we get closer to the election day itself. But I do think people will be on the more patient side until they have clarity.
Robert, let's cast it over to you. I mean, should I be more preoccupied by supply? I mean, the market has taken supply quite well this week in the United States on the investment grade front, likewise in Europe. Should I be more preoccupied about supply and the deficit now this year than what can come with whoever the next incumbent is?
I think the supply fear will be linked to who is going to be the next president.
Right.
And I'm not a politician. I'm not a political pundit. I'm not looking to tell you what should happen, but just based on what has happened, if we end up with President Biden in the White House, it looks like that would be more of a stasis in terms of the amount of supply out there. In other words, it stays massive. But when Trump was in 2016, after the election, there was a sell-off in the bond market on expectations for fiscal stimulus. That was quite substantial. There was a reprieve while nothing happened, and then another sell-off.
I got you.
So I think it could be a bearish situation there.
Okay, we've got a long way to run between now and the election. Don't worry, you'll get these questions again. Robert Tipp, Matt Hornback, and it will evolve. Coming up, we'll give you your morning calls right here on Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Your morning calls. First up, Jefferies upgrades American Airlines to a buy, expecting the shares to benefit from their upcoming investor day. Up next, Goldman downgrading Lyft to neutral, seeing a more balanced risk-reward. And finally, Oppenheimer upgrades MasterCard to outperform Go Shopping. The expectations are for an earnings per share growth and acceleration. Coming up, Bird's David George and Nuveen's Sarah Malik join me after the opening bell on Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Could face bigger challenges next.
Was going to keep rate World Cup.
This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
We're just about 30 seconds away from the opening of the cash market. We've managed to do an hour of prevarication across these markets. We've managed to swing it back into the green by 1% on the S&P 500. You might have a hotter, technically hotter CPI, but it doesn't assuage the market from taking a little bit of risk. There's the bell. Markets are flush, and we have a flat euro-dollar down by 1%. Yield spiked a little bit higher, but nothing too dramatic to provoke a repricing of a March rate cutting, the initiation of March as a rate cutting cycle. Bonds trade at 402. That is rich enough for some people to step in and buy the bonds here. My last set of guests thought bond market could back up to 425 and a little bit beyond. Crude rallies 2.5%. Again, a reassertion of geopolitical risk in the Red Sea and attacks from the Houthis. What will the coalition of the willing do to protect the maritime interests in the Red Sea? And 12% of global trade. One stock to watch, KB Home. The share is under pressure after reporting a decline in the average selling prices. Abigail Doolittle has the detail. Abby.
Hey, Manus. Well, this stock is under pressure, down more than 4%, the worst day going back to December 15th, so almost in a month. So they put up a big beat, but beneath the surface, not so great. As you mentioned, prices declined on a year-over-year basis. That means that even though adjusted earnings of $1.85 beat, they were down on a year-over-year basis by 32%. Revenues of $1.67 billion, down by 14% on a year-over-year basis. So for a stock that is up more than 150% out of the 2022 lows, it's just not enough. One bright spot, though, is the fact that they are seeing orders for the first 5 weeks of the first quarter of 2024. Well, they are higher, so perhaps things will turn around here. But again, this stock into today had been up 150%, price to perfection. Investors didn't quite get it out of that quarter.
Okay, I'll take a price drop in any property at the moment in this market. Abby, thank you very much. Let's turn it over to M&A. Chesapeake Energy agreeing to buy its rival, Southwestern. It's an all-stock deal worth roughly $7.4 billion. The timing of it, Simone Foxman can give us the details. Simone.
Yeah, Manus, the price there about $6.69 a share for Southwestern. Note that Southwestern closed yesterday's trading at $6.89 a share. For Chesapeake, this furthers their ambitions in natural gas, specifically as oil and gas majors try and consolidate. Expands their holdings in 2 key drilling regions, the Marcellus in Appalachia, as well as the Haynesville Basin, that's in Louisiana and East Texas. And especially that last one, this gives Chesapeake a little bit better access access to those export terminals that are on the Gulf of Mexico. Ahead of this announcement, because it had been something that many had been watching since the first deal, the potential deal was first reported in October, Stifel calling this the highest quality natural gas equity, but notably not moving too much on either end because this deal had largely been known about.
Yeah, well, there's certainly a few other deals that have gone through in the oil and gas sector. So what 2024 brings us, let's wait and see. Simone, thank you very much for the details. Let's turn our attention to the automakers. Tesla, never far from the news belt. Workers at the California plant will get pay increases across the U.S. factories. Katie Greifeld has the details. A generous boss. Katie.
We don't know how much of a pay increase, but all production associates, material handlers, and quality inspectors at Tesla's Fremont, California factory are getting a, quote, market adjustment pay increase. And with that boost, Tesla becomes the latest non-union automaker to raise pay in the months since the UAW's win over the big three automakers. Now, this factory in California, it employs more than 20,000 workers, and Bloomberg News has reported that employees at that plant have formed a UAW organizing committee. Tesla perhaps responding to that pressure, even though CEO Elon Musk has long been critical of the UAW and unions in general. Obviously, a different tune today. Madison shares down about 2%.
Okay, there we go, 229.36. Turn over to the financials now. It's going to be a huge day tomorrow on the results. But Citigroup already stating that they will set aside $1.5 billion to cover the risks on their exposure to Argentina and to Russia. Now, this comes ahead of tomorrow's quarterly results. Shonali Basak is with me on the details. Getting out early, giving us the bad news. It's a lovely setup for Friday. Shonali, good morning.
Good morning, and we know that Citigroup has a lot of complicated things to explain to investors, including what their turnaround story looks like going into this year. As you said, they are going to be setting aside $1.3 billion in a reserve build. They are being impacted by currency fluctuations, extreme fluctuations in Argentina, plus geopolitical risks in Russia. Remember, these are markets that they have been exiting. And as we look forward to Citigroup's story, remember, they also are pursuing a job-cutting plan and eliminating layers of management. By announcing this reserve build now, they can go ahead and tell investors what the plan is for this year and how they expect to expand revenue in addition to places outside they're already succeeding. They have been showing success at places like their treasury and trade solutions businesses. Now, can they bring up returns, Manis, to their investment bank and their markets businesses as well to bring returns closer in line to other Wall Street firms? Investors will also be looking at Citigroup's ability to manage expenses as they go through this turnaround story. Analysts calling this a pivotal year for Citigroup, where the shares have lagged its peers for the last 3 to 5 years.
Or to quote Mike Mayo, get ready for a metamorphosis. Sonali, thank you very much. Let's stick with the banks. Birds, David George joins me now for his outlook for the year. And this is what he says. We have a moderately constructive view towards banks as we enter 2024. We don't see the same upside today as we did during the sell-offs of 2023. Good to see you, David, with me. Can we just kick off with Jane Fraser's strategy, which is the big upfront reserve built for Argentina and Russia? The building narrative is this stock could triple in price from Mike Mayo. Would you be as bold as that on backing Jane Fraser at Citi?
Good morning. Thanks for having me, Manis. Unfortunately, I can't comment on Citi. I don't cover the stock, so I can't give you a whole lot of color there, but certainly happy to talk about banks as we get into earnings season. We're of the view that there's a fairly high bar going into earnings. The banks have had a very big move, 30% plus in the last 6 weeks, and we feel like the upside here is not nearly as significant from our perspective, and the bar from an earnings perspective is as high as we've seen in about a year or so. So it will be fascinating to see how results come in starting tomorrow morning.
I mean, that's, look, that sort of sets the bar low for expectations. I look at the big issues. I've got NIMS, I've got credit quality on commercial property, and I've got excess reserves. So I just want to break it down. What are you most nervous about in this reporting season?
Probably the net interest income outlook over the next couple of quarters. Loan growth continues to be pretty soft, and you continue to see a timing mismatch from funding costs going up at a faster rate than banks have been able to reprice their assets. So the combination of those two things we think could create a little bit of bumpiness over the next quarter or two from an expectation perspective. But from a credit quality standpoint, we feel pretty good about where we sit. And clearly there's been a lot of gnashing of teeth around this commercial real estate and office issue. We think that that's largely reserved for by a lot of these banks, so we're not particularly concerned about that. But it's really a function of revenue growth from here is, I think, what we're certainly going to be focused on.
I mean, I'm looking at some of your favorites out there, and it's Citizens, it's Commercia, it's Huntington. So again, I saw some hedges go through on these more regional bank players. Why are you pitching these names on the favorites list at the moment?
Well, from our standpoint, the large cap part of the market has moved much faster and much more significant than the regional banks. And typically, the regionals trade at a premium to the money centers or the mega caps, and that really has flipped over the last 6 to 18 months. And we think that the opportunity set is the best in that regional bank group, just simply because the valuation construct and setup, from our standpoint at least, looks much more attractive. You've got several stocks, Manus, trading at 7, 8 times earnings, whereas the money center banks like a JP Morgan, for example, is trading at 11 times. So it's really just a risk-reward trade-off and finding a preference for smaller regionals than the money centers here.
Yeah, the blood is rich at the top. They say it's royal almost at the top there at JP Morgan. We've got $145 billion of excess capital. Now, it took greater minds than me to come up with that. That's Bloomberg Intelligence. So we have a collective excess capital in 8 USA systemic banks. JP Morgan leads the overall. But the question that it begs is, do you expect a significant payout dividend buyback 2024 across the sector? Is that what's going to perhaps help put a floor under some of this?
Yeah, in a word, Manus, no. Unfortunately, from our perspective, 2024 is going to be a year of capital building for the banking industry, and that unfortunately is going to happen relatively quickly, we think, with limited loan demand at the moment and pretty good inherent profitability. We think the group is going to really across the board, big, small, and mid-size. 2024 is a significant capital building year, and I think 2025 has the potential for not only significant buybacks and potentially some small dividend increases. We also think that you're going to see a fairly significant improvement in net interest margin, net interest income in 2025 as, again, we get that kind of catch up on the asset side, loan repricing, securities repricing, et cetera, have a very positive impact on profitability next year in 2025.
Okay, so I'm wrong on some of the most basic assumptions then. But look, there you go. We've got KBW. It did get a little bit of a boost into the back end of 2023. David, you set a formidable table for us to keep an eye on. David George there on the banks. Nuveen's Sarah Malik is with me weighing in on the upcoming earnings season. Now, this is it. The bar is higher than the past quarters. However, a weaker dollar, a stronger economy may lead to an earnings per share upside versus consensus. Sarah, good to have you with me. I mean, everybody's pitching in with their view on earnings season for this quarter. So where do you think the strength will come in the earnings per share?
Well, Manus, it's good to see you. You know, markets started off this year with a bit of a hangover, and I think there's going to be 3 reasons why we're starting to see a change in that. One is CPI, second is earnings seasons, and third is the conference circuit. So starting with earnings, yes, we are seeing about 3% consensus earnings growth year over year, but where we think there could be upside is that consensus is expecting margins to contract by almost 100 basis points. I think that's too pessimistic. So I think earnings season could be a positive catalyst for the market. Now, switching back to CPI, the story is not as rosy here, especially with Supercore, which is what the Fed focuses on. That has proven to be very sticky because of wage inflation. We also saw goods inflation coming in less negative, and the surprise of used car prices increasing again. So I think inflation, however, today gives 1 more point to the bears. And then, of course, the conference circuit, CES, giving a bit of wind back into the sales of technology stocks, and the JP Morgan Healthcare Conference, where people are looking for, is there going to be more M&A in biotech and also in the med tech business? Also, those stocks also are getting covered because there's some optimism there.
Well, let's just break part of it down. Many people, look, the market is pricing in 5/6. The CPI and the Supercore behaved itself today. Maybe it's the PCE that will redefine the narrative on rate cuts and risk in the next couple of weeks. But you say that we can expect an elongated rate pause. Translate that for me, and therefore, does that undermine? The natural question is the 6 cuts that are baked in, and what does that do for risk for you?
Well, one of the key questions this year is what will the Fed do? Today's CPI number tells you likely not 6 rate cuts, with the first one starting in March of 2024. CPI coming in hotter than expected. Our view has been that what we're going to see is more of an elongated pause. The Fed is not going to rush to start implementing those rate cuts. I think they start later this year, and the Fed's goal will be not to really tighten or loosen monetary policy, but to keep real rates stable. So they'll somewhat cut rates maybe 3 to 4 times in order to keep real rates stable, because inflation has been declining. But I don't see them going so far as to loosen policy. And that's what you get with 6 rate cuts. That's why we're coming in under on that. We see less rate cuts, and we see them starting later because the Fed needs more data around inflation easing. The other side of that is the economy. The economy is strong. So the Fed is not in a rush to cut rates because we're in a recession. The economy has been strong enough so we can keep rates stable for a while.
I like what you say. We started 2024 with a hangover, which leaves me with many choices of what to eat on the morning after the night before, which is either defensive play or run a mile from Magnificent 7. You know, Mag 7 will turn into Lag 7, or go for breath. So those are your 3 hangover cures. Tell me which one you want to pick.
Yeah, I mean, my personal one is probably more greasy food. But when it comes to stocks, exactly, in a world where we do worry that the economy may start to slow eventually this year, we're becoming a little bit more defensive. Also, market valuations coming into this year at quite a premium given the 2023 returns. So defensive areas like infrastructure, which is more resilient when the economy slows. Dividend growers, for those looking to get their cash off the sidelines back into equities. Dividend growers pay you some income because these companies increase their dividends over time, and they tend to perform a little bit better during periods of downside volatility. We also like fixed income, higher quality like investment grade, and municipal bonds, where the fundamentals are very strong for that sector still.
David George just blew my tires out on banks. I was sort of like bullish on buybacks. I was bullish on dividends. I was sort of almost bullish on net interest income, but that got quashed. In a few short words, would you be long financials into 2024? 30 seconds, wrap it up for me.
I think it's tough on financials here. We're coming in with positive sentiment due to the expectation for lower rates, but they had a strong run in 2023 at the end of the year. There's still regulatory issues with higher capital requirements. You have to be selective. I like the regional banks, also Wells Fargo, for the turnaround story.
You can give him a call. He's got some nice calls on the regional banks there. You can do a trade. Sarah Malik, thank you very much. Rounding out and setting the agenda for 24. Coming up, the first ever Bitcoin ETF. It starts trading today. That conversation is next.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
We think that the Fed probably won't start cutting rates until around June. And the key thing will be the course of inflation. The good news is that core inflation is still slowing, but the Fed also cares about the headline. And certainly when we look in the core, if home prices are still rising month on month, that doesn't bode well for year on year.
Dan Peterson there at the conference board weighing in on U.S. inflation. Speeding up at the close of 2023 challenges the market's expectations that the Federal Reserve will soon start cutting their rates in March. Turning to crypto, investors rejoicing after the SEC approved the first ever Bitcoin spot ETF. It was a rare move by the agency after a decade of opposition. The chair, Gary Gensler, wrote this: Bitcoin is primarily a speculative, volatile asset that's also used for illicit activity. While we approve the listing and the trading of certain spot Bitcoin ETP shares today, we did not approve or endorse Bitcoin. Trading begins today. Katie Greifeld joins me now. I mean, that's a heck of a non-endorsement by Gensler, isn't it?
Yeah, kicking and screaming, but it finally happened, Manus. The SEC did give its blessing to those U.S.-listed spot Bitcoin ETFs. About 10 or so started trading at 9:30 a.m. today, a cool 19 minutes ago. And like you said, this comes after more than a decade since the first spot Bitcoin ETF application was filed back in 2013 by the Winklevoss twins. Now, as you read from SEC Chair Gary Gensler, this was not an endorsement of Bitcoin. And he also wrote that investors should remain cautious about the myriad risks associated with Bitcoin. So again, not exactly ringing there. But on the other side of that, you did have Commissioner Hester Peirce on the other side telling Bloomberg TV yesterday that while she was delighted with the result, there are still pieces of it to go, but this is a big milestone nonetheless. And despite that difference in opinion between the chair and some of the commissioners, this ultimately came down to a 3-2 vote of the SEC commissioners, and Gary Gensler was the deciding vote in favor. Now, with these funds finally out the door, the question becomes, does the world really need 10 or 11 U.S.-listed spot Bitcoin ETFs? But of course, that story will take a little while to play out, Manus.
Well, it depends. They're going for the jugular on the fees, aren't they? Katie, thank you very much. Wrapping it up there. Meanwhile, crypto stocks, they're getting a fresh boost from the Bitcoin ETF approval. Alex Semenova joins me with more.
Hey, Manus, good morning. Crypto equities are, of course, big beneficiaries here, getting a fresh momentum boost after an already incredible run-up to this decision last year. Think crypto exchanges, crypto miners, all extending the gravity-defying gains that they saw back in 2023. Coinbase, the crypto equity poster child, and miners like CleanSpark and Marathon Digital Holdings are some of the names moving higher this morning after an incredible run. Coinbase, for example, last year gained 250%, now building on that monster advance. Now, always interesting to see some of the Wall Street commentary. Analysts at Deutsche Bank said that this decision marks a significant milestone. They see Bitcoin gaining through the end of the year. Of course, a positive for these crypto-adjacent names. However, they did emphasize not to conflate price gains with broader predictions of crypto overtaking traditional finance. And this momentum ETF approval by the SEC is, of course, bolstering some of those crypto names. Keep an eye on names like Bect, Cipher Mining, Riot Platforms, and TeraWolf as well. Manus.
Okay, big day for crypto. Alex, thank you very much. And tune in for our interview with the Grayscale CEO. That is at 1 p.m. Eastern Time on a special edition of Bloomberg Crypto. Some more price action for you in the sectors. Let's get to Abigail Doolittle. Abby, what have you got?
It's interesting sector action today, Manus, because right now we have the S&P 500 down by about 0.1%. But the sector action, I would say, is neutral to possibly even risk on. I say that because the top sectors are communication services and tech. So basically those mega cap tech sectors, energy slightly higher. To the downside, utilities, that's a defensive sector. So in a way, there's a risk-on tone to that. And there are other defensive sectors that are down. One big story in the day, tech's gain at this point is pretty small. Microsoft up about 0.75%. Apple down about 0.75%. Manus, right now we have Microsoft taking out Apple from a market cap standpoint, both right about 2.8 trillion above there, closer to 2.9. Microsoft ever so slightly above. And I think, I'm checking right now, I think that Microsoft is actually putting in a new record high. I'm looking for that. Yes, Microsoft at a record high.
There you go, record after record. Who said that Mag 7 was done? Abigail, thank you very much. Coming up, the market moving events for your trading day. It is your Trader's Diary.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
Let's get you up to speed with your trading diary. But before we do that, I want to show you Bitcoin up 6%. You're looking at this cryptocurrency lit up. You're looking at the highest level since the latter part of 2021 for the market. In terms of the ETF being agreed upon. Your trading diary, let's set your agenda for you. We've got the Cleveland Fed President Loretta Master, the Richmond Fed President Tom Bark, and they speak later today. Plus, a little bit more of a bond auction. Can you take some more? $21 billion of 30-year. If you want duration, it's on the slate today. Friday, we're building up to the bank earnings, kicking off ahead of the opening bell. Plus, we will give you the PPI, post-CPI. Is there anything there that we can tell you? Supercore CPI, fairly well behaved. Finally, Neil Kashkari will speak. That is a roster of Fed speak for us to digest in the morning. I can tell you Bitcoin is the highest since the 27th of December, 2021. Up 6% on the day. Is there more fuel in the tank for crypto? That's it for Countdown to the Open. I'm Manus Cranny. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Stocks a little bit mixed here, a little bit in the red here after that CPI print came in just a smidge hotter than expected. We're going to get the market call here. Brooke May, managing partner at Evans May Wealth. Then we're going to check in with Vince Piazza, another deal in the shale business. Vince Piazza, he covers all the energy stuff for Bloomberg Intelligence. He'll join us here because he's been talking about this for a long time. A lot of consolidation going on in the energy space. We'll get the latest deals and the details there. And then it is a big day in the Bitcoin spot ETF business. The SEC approved these ETFs yesterday, so we've got a bunch of them trading today. James Seifert, ETF analyst at Bloomberg Intelligence, one of the most expert voices on Wall Street on this whole ETF business, will tell us what's important here. We're going to kick things off right here on this Thursday morning with John Tucker at Bloomberg Business Flash.
All right, Paul. The reaction kind of ho-hum to the data today. Americans did pay more for housing and driving, so that led the Consumer Price Index to increase 3.4% in the year through December. That's the most in 3 months. Also, separately, weekly jobless claims continue to run low. Initial jobless claims holding steady at a historically low level. Meantime, Dana Peterson, chief economist at the Conference Board, reacted to this morning's Consumer Price Index.
We think that the Fed probably won't start cutting rates until around June. And the key thing will be the course of inflation. The good news is that core inflation is still slowing, but the Fed also cares about the headline. And certainly when we look in the core, if home prices are still rising month on month, that doesn't bode well for year on year.
And right now, 3 of the 11 major industry groups in the S&P 500 were higher. Communication services in the lead. That's where you're going to find shares of Netflix. That is reflecting optimism about the streaming video company's ad-supported subscriber tier. Right now, the S&P 500, 7 points higher. I mentioned earlier, it did cross the record high that was set 2 years ago. Right now, lower again, down 8 points, down 0.2%, 47.74 in the index. The Dow Jones Industrial Average down 108 points, and the Nasdaq 100 just 2 points lower right now. And this Bloomberg Business Flash, being brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit IBKR.com. I would be remiss if I didn't quote the iShares Bitcoin Trust. 33%. What's that? Old dog, new trick. It's, yeah, old dog. You definitely got that right. Up 33%. The ticker symbol IBIT.
Yeah, that's, and I'm looking at just 14 million shares have traded. That seems like a lot. I don't know. But we'll check in with James Seifert. He's in Bloomberg Intelligence. He'll tell us what's going on here. But I guess there was initial fixed price of 22, like an IPO price equivalent, and now we're up 32% off of that, I guess.
Yeah, it's at 29.08, so up 7.12.
Yeah,
so
there we go. All
there
right,
you
John
go.
Tucker, very good. Thank you so much. We appreciate that. Lisa Mateo, once again, sitting in and co-piloting this for the next 3 hours. Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. And I want to call out here at the bottom of the hour, 10:35 a.m. Wall Street time. BlackRock ETF executive Jay Jacobs is going to sit down with Bloomberg's Katie Greifeld. So we're going to hear right from one of the leaders in this new industry, well, new asset class, new trading vehicles, the spot Bitcoin EPS. We're going to, from one of the biggest ones out there, kind of how this is playing out today. All right, let's kick things off here. We got some red on the screen, but let's check in with Nora Melinda. She's Bloomberg Equities reporter. She joins us here in our Bloomberg Interactive Broker Studio. Nora, what are you looking at today?
Keeping an eye on quite a few cryptocurrency-linked stocks after U.S. regulators for the first time approved ETFs that invest directly in Bitcoin. Of course, this has been a story that everyone's really been watching. That landmark decision by the SEC yesterday came as a game changer for the roughly $1.7 trillion digital asset sector, broadening access to the largest cryptocurrency on Wall Street and beyond. So really just looking at Coinbase, it's now lower, of course, as the broader market is falling, but it was earlier up as much as 6.4%. Wedbush raised its price target on Coinbase to $180 from $110 on the news. And Deutsche Bank analysts say, for now, the spot Bitcoin ETF approval opens a new chapter for Bitcoin prices, though volatile conditions are likely to persist.
It's going to be interesting to dig into this later.
Yeah.
When we do have someone in to talk about it, talk about those management fees that are down to near zero in some cases.
What else are you looking at?
Taking a look at Hertz, falling as much as 6% this morning. Shares are sinking after the rental car company made its strategic decision to sell about 20,000 EVs from its U.S. fleet. That's
This story just
huge, right?
Talk
crazy.
about an about face.
I mean,
I'm saying
what happened to the? I mean, this more than we've all been asking this question. What is the ultimate demand? What is the real demand for EVs? Man, this is a data point that tells you it ain't there, or certainly not where what we thought it was going to be. Yeah.
Yes, I mean, Vital Knowledge said that bullish investors may say that this decision to slash its EV fleet could be a big positive going forward by reducing the huge cost headwinds associated with car repair. But of course, you know, everyone has a different perspective on this. But as you mentioned, this is a really massive data point that has everyone floored, much like you.
Yeah, and there was a story in the Bloomberg Terminal about, again, going to the cost of maintaining EVs, the tires.
Mm-hmm.
You know, the tires are only almost half the life as it is for, just simply because of the weight, the heavier weight of these electric vehicles.
And the amount of time that they sit in the repair shop because they're finding the parts. You know, that's the other part of it too.
Right. So this is, you know, I guess if you talk to the real EV, you know, pioneers and people that really believe in it, they're saying this is fits and starts. This is going to take a while to develop this whole ecosystem, but we're going to get there. And this may be one of those fits and starts. Or if you talk to some of the more pessimistic people, they're like, the market's just not there. I mean, you have the early adopters, the people who just are into, you know, clean energy. Okay, they bought their vehicles or they're going to buy their vehicles. Everybody else is like, eh.
Right. I mean, Lisa, are you into EVs?
I am not. I'm kind of nervous about it. I may go hybrid, halfway.
Okay.
I'll meet you halfway, but
it depends
yeah,
what size.
I'm not ready to go all in. I'm not.
Yeah,
I'm right there with you. We'll see.
Yeah, I mean, I just bought a new car, and you know, you had the option to take a look at the EV version, but it was materially more expensive to go from ICE to, and for me, the value of going EV, it just is not there at all. Like I won't pay any premium to it. If you want to make it the same cost, then I'll consider it maybe.
Right.
So anyway.
One last thought for you all. Looking at KB Home, that's a home builder. I cover real estate. They reported earnings yesterday. The stock is falling as much as 4.2%. For its worst day since October, on pace for that. Essentially, it reported a year-over-year decline in its average fourth quarter selling price and a weaker forecast for housing revenue for 2024. As we know, home builder stocks have really been soaring, especially as they're taking market share from a lot of these existing homes. So this had investors a bit worried as we're hearing this news from KB Home.
Okay, interesting, because I just thought it was just continue to the races for these. They can't
that's
sell
what
them
we're
fast
all
enough.
thinking. That's what we're all thinking. Right.
Yeah. Okay. Very good. We'll keep an eye on that. Again, these stocks have been up. I'm looking at some of these peers here up all over on a trailing 12-month basis, over 70, 80%. So just some big moves in the housing stocks over the past 12 months. Norma Linda, thanks so much for joining us. Norma Linda, she covers all the equity markets for Bloomberg News. All right, let's get the market call here, because I'm not sure kind of what we're doing here in 2024, given the great outperformance we had in that fourth quarter of 2023. But fortunately, we have somebody here who's got some informed opinion. Brooke May, managing partner at Evans May Wealth. Hey, Brooke, I'd be interested to see what you're telling your clients here in these early days of 2024, particularly with how strong we ended the year in 2023. What's the message?
Good morning. We're optimistic. We have a 5,200 to 5,400 price target on the S&P for next year.
Nice.
And while 60 days ago that seemed pretty lofty, it's a lot more probable now. When we look at where that's going to come from, it's not necessarily multiple expansion as much as just earnings growth. The economy is still strong. We look at the consumer, they're continuing to spend. Unemployment is low. And so we feel like that's going to translate to earnings, as we saw with the third quarter earnings, and now as fourth quarter earnings are coming in. They're better than expected. And we think that that'll continue, and we'll see some upside revisions to earnings expectations for 2024.
Now, Brooke, in your notes, you say resist the urge to buy certain sectors. Get into that for us for a bit.
Yeah, we feel like right now there's really a divergence between companies that saw the interest rate increases and were able to navigate it. They had 2 years to prepare. And what we saw with earnings expectations is even within one sector, some companies fared a lot better than others. And so we think you still have to step back, take a look at the balance sheet, look at which companies are much more sensitive to higher interest rates. We're in the camp that inflation is going to be sticky. It's going to take some time to grind lower, as we saw this morning. 2 steps forward, 1 step back. And so when we look at where inflation's going, it's down, but it's going to be slow. And we think it's going to be the second half of this year, before the Fed starts to cut rates. And we might only see 3 or 4 rate cuts during the year, which means companies that are very dependent on debt to operate, if they have the variable rate debt, it's going to cut into their earnings. So you have to be company specific. When you look at the Russell 2000, only about 60% of those companies are profitable. And companies that aren't profitable are operating off of debt. And about 30% of the debt within Russell 2000 companies is at variable rates.
So, yeah, rates coming down, certainly a positive there. So, Brooke, as we look back at 2023, if you're in those magnificent 7 names, boy, you did well, like Mr. John Tucker. But the rest of us, we might have to catch up a little bit in 2024. What do I try to chase those big tech performers, or do I try to maybe look someplace else for value?
We're not making big shifts. We still like the Magnificent 7. They've got earnings, and they've got earnings growth. So we feel like they can continue to do well. They're expensive, but when you look at their earnings growth expectations, it's not excessively expensive. But there are a lot of companies right now that have the opportunity to catch up. Those that have struggled, haven't necessarily participated in the rally. And so if you go out and you look at what companies have the potential to do well as rates come down, we think that there's some opportunity there in those other 493 names.
And I got to ask you about Bitcoin. Today we had those newly launched ETFs. How are you advising your clients right now about it?
We're hesitant. We do think cryptocurrency is here to stay. So we know that that's where the industry is going, and we're going to see more and more adoption. However, there's still a lot of uncertainty, and it's really hard to value what a good entry point is into Bitcoin or crypto. So it's something that we would consider for our clients down the road, but we'd like more clarity around what the regulatory issues are going to be and how the adoption is going to go and really how to fairly value it. So it's not something that we're adding to portfolios today, but we'll continue to reassess and can potentially do down the road.
Hey, Brooke, I know you guys like financials, and I think that's not necessarily consensus. I think that people are definitely concerned about some of the financial space here. What are a couple of names that jump out at you? Because we're going to have, as you know, the big banks starting reporting earnings tomorrow. So how do you guys typically like to play the financial space?
Yeah. Right now, we like financials, but just in the near term.
Okay.
I do think that there are going to be some upside surprises. But with upcoming regulatory issues, we're not necessarily looking to buy the sector as a whole down the road. There are a few names, though, that I think have really decent entry points right now and that we do own in the portfolio, and we're hoping to see a little bit of a bump in here in the very near term. One is Goldman Sachs. When you look at their earnings from last year to next year, they haven't been decimated as much as some of their peers. And we think that IPOs and M&A activity is going to come back in 2024. So they're trading at 18 or 19 times forward earnings, but when you look at the growth rate, that's not excessively expensive. And they're not trading too much above their tangible book value. So there's a lot there that we think could provide a nice bump going into this year.
And Brooke, if you want to beef up your fixed income holding, where are you looking?
We like the intermediate point of the curve. With the 10-year Treasury above 4%, you add a little bit of a bump there for corporate bonds, high quality corporate bonds. We think that investors, should be looking to lock in 4.5%, 5% where they can find it. So we like corporates, we really like munis, but we're trying to ladder out bonds in that 5 to 10-year space just to lock in the rates that we have today.
One of the underpinnings of this market for 2024, for a lot of folks' perspective, is earnings growth. I'm just looking at the S&P 500 on the Bloomberg terminal. Looks like analysts have about 11 or 12% earnings growth for 2024. Are you comfortable with that level of earnings growth baked in here, or do you think there's earnings risk here for this market?
No, I'm very comfortable with that level. When you look at the multiple that the market's trading at today, 20 or 21 times, and you extrapolate that out with 11% earnings growth, that's where we're getting to our 5,200, 5,400 price target. So we think that 11% is very probable, and it could even be higher.
And what's different this year? I mean, are investors, are they going to have to take a more active approach to their portfolio, or are they going to have to switch off the autopilot? What looks different this year?
Yeah, we think you need to be flexible this year. So I don't think that you can set your strategy for the year and just let it ride. We think you're going to have to be selective. We do like the idea of picking names versus just buying the broad market. We've seen volatility very low, and that's not going to continue. So there are going to be opportunities whenever we see volatility kick up to go in and buy, but be selective.
One of the drivers that I think the permables out there, Brooke, say about this market is, hey, there's a lot of cash on the sidelines, and as rates come down, investors are going to look for higher returns elsewhere, and maybe that means the stock market. Is that something you guys ascribe to?
Absolutely. $6 trillion in cash and money markets. Of that, I think 1.4 trillion was just added last year. So there's a lot of cash on the sidelines. And there's a lot of people who are kicking themselves for not being fully invested over the last few years. And so we think that as that money comes back into equities, we're going to see a bump in the market, and that's going to just be an additional tailwind to push the market higher.
All right, Brooke, I know you're a big Indiana University grad here. Can you explain to me what the heck a Hoosier is?
I don't really know. Someone who lives in Indiana.
That's probably the best answer I've gotten. I mean, I've asked a million of these people, what the heck's a Hoosier? Am I missing something here? Is it like some mascot, some animal I'm not aware of? But anyway, good stuff, Brooke. Thanks so much for joining us. Brooke May is a managing partner, Evans May Wealth, located out there in the great state of Indiana. They know a thing or two about basketball out there. So again, one of those things that kind of gets my attention is that $6 trillion of cash on the sidelines. Now, Barry Ritholtz says don't look at that because it's always out there, more or less, the dollar amount. Don't buy the market because you think that cash is going to go into the stock market. But it still gets my attention, though. I mean, particularly as interest rates are, in fact.
So put the blinders on. That's what he's saying?
Well, no, he's just saying he says that's just not one of the. There's some things, some pet peeves he has about people when they talk about the market, and one of them is there's cash on the sidelines. It's got to go to work. Well, no, it doesn't have to. I mean, it's there for a reason, maybe. But my thought is when interest rates were low, that was a reasonable environment. Now that interest rates are in fact coming down from relatively high levels, that makes a little bit more sense. Cash on the sidelines. I'm not getting the rate I got maybe a little while ago, so maybe that's my incentive to come off the sidelines, get into some risk assets, including equity. So we'll see how that plays out. S&P 500 right now off 0.5%. Same for the NASDAQ. The Dow off 0.6%. This is Bloomberg. Get some company news right now with Denise Pellegrini.
All right, thank you guys. Well, we've been talking a lot today about inflation, and now we have word that Tesla is raising prices for U.S. workers. That's as the UAW tries to unionize there. Separately, Hertz says it's cutting some of its electric vehicles out of its fleet, calling electric vehicles expensive to maintain. Transportation Secretary Pete Buttigieg, commenting on Boeing and those MAX 9 planes, says they will remain grounded until regulators deem them safe to fly again. He says safety is the most important thing, and Boeing shares they are lower this hour. Major deal in the energy industry. Chesapeake Energy agreeing to acquire rival Southwestern for about $7.4 billion. More on that from Bloomberg's Charlie Pellet.
Denise, this is an all-stock deal, and it will create one of the largest American natural gas producers. Oklahoma-based Chesapeake is paying $6.69 a share, and the takeover of Texas-based Southwestern is expected to close next quarter following needed regulatory approvals. The acquisition expands Chesapeake's holdings in two key drilling regions, the Marcellus Basin in Appalachia and Haynesville Basin in Louisiana and East Texas. The deal also positions Chesapeake to compete better against its big domestic rival, EQT. Charlie Pellet, Bloomberg Radio.
All right, thank you, Charlie. And there's some angry football fans right now because Saturday night's playoff game will be broadcast on TV only in the Miami and Kansas City markets. Now, outside those two markets, if you want to watch it, it'll be carried exclusively on the Peacock streaming platform. That means some diehard fans won't be able to watch. And those are some of the company stories we're following this hour. I'm Denise.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. After crossing over its record close from 2 years ago, the S&P 500 has dropped off all 11 major industry groups in the index. They are lower right now. Utilities, real estate, the biggest drags. Energy, the best performer. You have crude oil, that is rising today. And Citibank, this is ahead of the earnings report from the financials that start Friday, says in a filing it would set aside $1.3 billion reserve covering risk in both Argentina and Russia. And my friend Kriti Gupta points out, analysts at Piper Sandler expect the charges to make for a quote, super messy print come Friday. S&P 500 right now 16 points lower. That is down 0.4%, 47.66 on the index. The Dow Jones Industrial Average 169 points lower. That's down about 0.5%. The Nasdaq 100 44 points lower. That is down 0.3%. After the little hotter than expected CPI report today, the 2-year yield, not much movement there. They're actually down 2 basis points at 4.33. The 10-year unchanged at 4.03%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Oh, there I did it again. The iShares Bitcoin Trust, ticker symbol IBIT, 25% higher right now in its initial day of trading. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. I'm getting forgetful, Lisa, as I get older.
It happens. That's okay.
Well, you're calling it out here. We're covering this, these Bitcoin ETFs. And again, Eric Balchunas, who's one of the experts from Bloomberg Intelligence on this whole space, he says follow the one that John Tucker is quoting, which is the iShares Bitcoin Trust. IBIT is the ticker. That's got the most amount of assets, and that'll probably be the best proxy for how these ETFs are trading. And he said pay attention to not only the price, which John just reported up 25%, but also the volume. Over 17 million shares have traded. So I don't know. That seems like a lot to me.
I don't. Is that good volume?
I don't know. It seems like a lot.
What's it compared?
Well, I'm looking at some of the other ETFs, and this is by far the biggest. So, so again, we'll talk to James Seifert, also Bloomberg Intelligence, and get some more color there. All right, another deal in the energy space. This time, Chesapeake Energy going to buy Southwestern Energy for $7.4 billion in an all-stock deal. So, I mean, crazy, which means we get the opportunity to speak to our good friend Vince Piazza, senior industry analyst, covering all the energy space for Bloomberg Intelligence. And, of course, the highlight of his career, former sportscaster, talk show host at the famed WFUV radio station at Fordham University, which has launched so many legendary broadcasting careers, particularly in the sports biz. Vince, we'll talk radio at another time. Let's talk about this deal here. What's going on in your business here? The consolidation is fast and furious, isn't it?
It really is, and we talked about this in our outlook for 2024. The consolidation continues. You know, we have reached a maturity phase in this industry. We had the shakeout, and now you have established players looking for increased scale and concentration. You're selling a commodity. There's little differentiation. The only way you can differentiate is by having more of it so that you can gain efficiencies, economies of scale, better productivity. And this is a prime example, Paul, right? So you have two very large players getting together to form the third largest natural gas producer behind Chevron and Exxon. So this is a globally relevant producer that will have access via its exposure to the Haynesville Shale to Gulf Coast markets, seaborne markets, and being able to push those flows out there in the international marketplace, which allows for greater diversification of selling hubs. You know, they're going to be exposed roughly 20-25% to that seaborne market. They're going to have various selling hubs that they can push product through, something like over 24. So the deal makes sense on paper. What I don't think most folks are really focusing on, and I invite you all to touch base with Jennifer Rhee. She's our antitrust specialist. This deal will get lots of scrutiny, I think.
That's what I was going to ask.
A deal like EQT buying up quantum assets for about $4.5 billion, that deal took about a year to close. So this is a much larger deal. It's much more concentrated in two very important specific plays. And so I think that's going to get a lot more scrutiny. So this isn't a done deal, but on paper, it is a very rational rational approach to a commoditized marketplace.
Yeah, you read my mind, Vince, because I was going to ask you, what does the FTC think on these, large gas and oil deals? I got to talk about this whole trend of consolidation. Are we going to see this continue into 2024? I mean, is this going to be a big part of all these companies gaining scale?
Yeah, as part of our outlook, we looked at gas in general relative to oil, and we have had all of these deals in the Permian, but gas deals have been rather quiet in 2023, and that's because of the way the benchmarks performed in 2023. We think that nat gas, the worst is past nat gas. We could see better improvement in tighter markets for 2024. We think the market tightness will show itself in the second half, so we think we will have more consolidation in the natural gas space. This will likely set things off. How EQT responds, which was the largest producer, still is the largest producer until this deal closes, how they respond will be very important. Antero and CNX have been relatively absent from the M&A game. How they respond will be very important as well. So it will likely set off a mini wave of decisions that many of these operators will have to make in order to gain that scale. The scale and concentration is very important when you're selling a commoditized asset.
So, Vince, I see the stock of Chesapeake Energy is actually up about 6%. You don't often or always see that when the acquirer makes a deal here because there might be some dilution concerns. Why do you think this stock is up here? Is this a good valuation aside from the strategic side to it?
I think it's exclusively about the strategic rationale behind the deal. And when you think about the 2025 strip, things should look better for natural gas market, natural gas sentiment in general. So I think it's a vote of confidence about the deal. And I think it's a vote of confidence for nat gas going forward. You want to have more assets in concentrated hands and more solid hands.
How fragmented, Vince, does this natural gas and still remain today? Are there private players out there that can be rolled up, or are we looking at a handful of public companies that just have to figure out who's going to go with who?
Yeah, so if you think about where Chesapeake came from and where Southwestern came from, even EQT, you saw public buying private as the PE firms monetize their legacy investments to regenerate that capital. What we're going to see now, I think, is still a good amount of public buying private, but I think now we're going to see public on public mergers of equals, low premium consolidation as well. Because I think the next step is investors still want to see free cash flow. They want to see the return of excess cash. We had all this investment in the space during Shale 1.0, where a lot of capital was sunk in the ground to prove up the assets. We now have these assets proved up. It is a manufacturing process now, and now we've hit the point of maturity where there's not a lot of growth capital. So it's really sucking out that excess cash, growing at a more modest pace, controlling your expenses because you have that scale, because you have that concentration, and generating that free cash flow that right now in general is in the high single digits to low teens for the industry, and giving back that capital to the investor base. Debt is not really an issue, and a lot of the maturities have been pushed out, so leverage isn't really a concern.
Hey, Vince, before you go, I have to ask APA's Calon purchase. I read your article. You said it's not all it's cracked up to be.
Yeah, so it's interesting because usually when you consolidate, you consolidate for scale, you are buying up near acreage or near assets. In this case, the assets seem to be somewhat diffuse from where APA is historically located. So I think that deal was done to generate cash flow as a cash flow bridge for APA to get past this period of uncertainty when their longer term, their longer cycle assets come online.
Hey, Vince, always good to talk to you. Lots of deal flow in your space. We appreciate you giving us some time here as we try to piece it all together. Vince Piazza, he's a senior energy analyst at Bloomberg Intelligence. Another deal in the natural gas space, the shale space, so we stay on top of it. The good analysts, the research analysts go and keep on top of it as well. Right now, let's head down to Washington, D.C. We get world and national news with Amy Mars.
All right, thank you, Paul. The same-day GOP presidential hopefuls Ron DeSantis and Nikki Haley went head-to-head at the last debate before the Iowa caucuses. Rival Chris Christie then dropped out of the race. The fifth Republican presidential debate featured just two candidates, DeSantis and Haley. They clashed over the economy, foreign policy, and their own home state records. Bloomberg government reporter Jack Fitzpatrick.
Well, I think you could sense that the pressure was rising as Nikki Haley and Ron DeSantis see themselves as the only last two options to fighting for the spot as the non-Trump alternative.
Meanwhile, former New Jersey Governor Chris Christie says there's just no path for him to win the nomination, so he suspended his campaign, but he also said his work isn't done.
I am going to make sure that in no way do I enable Donald Trump to ever be president of the United States again.
Former President Donald Trump, meanwhile, skipped the debate. He attended a town hall on Fox. This morning, he is in court for closing arguments at his civil fraud trial in New York. Harvard University was sued by Jewish students who claim the school has failed to punish campus anti-Semitism that soared after the Hamas attack on Israel and helped lead to the ouster of President Claudine Gay. Students cited a U.S. civil rights law that's been used to sue New York University, the University of Pennsylvania, and the University of California, Berkeley. Harvard's press office did not immediately respond to a request for comment. The most successful pairing of a coach and franchise in NFL history is over now. Bill Belichick is set to leave the New England Patriots. According to multiple reports, they've scheduled a press conference for noon Eastern time today, where Belichick and team owner Robert Kraft will be addressing the media. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul.
All right, Amy Mars, thank you so much. We appreciate that. In just moments, where Katie Greifeld from Bloomberg is going to sit down with Jay Jacobs, BlackRock ETF executive. So we'll talk about the new Bitcoin ETFs. We had 11 of them hit the market today. I'm looking at the iShares Bitcoin Trust. IBIT is the ticker, and that is trading 25% higher than, I guess, the reference price is what I'm going to call it, of $22 per ETF share. And about 19 million shares, almost 19 million shares have traded. So a lot of volume here, a lot of interest in it. Underlying Bitcoin up 3.6%, 47,600. So again, a lot of activity, huge day in the world of crypto and ETFs. When you bring two of the hottest areas of finance together, really big day here for that. So that's why we're fortunate that BlackRock ETF executive Jay Jacobs, right now he's sitting down with Bloomberg's Katie Greifeld. Let's take a listen.
We welcome now our Bloomberg TV and radio audiences. We're going to continue our coverage of the 11 spot Bitcoin ETFs that hit the market today. We're joined by Jay Jacobs, BlackRock US Head of Thematics and Active Equity ETFs, and of course, Bloomberg's Katie Greifeld. Katie, take it away.
All right. Thank you guys so much. And thank you, Jay, for being here. I know it's a pretty busy day, to put it mildly. Let's take a look at the iShares Bitcoin Trust. The ticker there is IBIT. If you take a look at volume right now, it is definitely winning that race with almost 19 million shares traded. But let's talk about assets and let's talk about flows, because Bloomberg Intelligence has estimated that it's possible that BlackRock has seeded IBIT with $2 billion. So first question, is this fund seeded?
Look, I can't comment on or speculate on flows today. What we're really focused on is the volume and, frankly, the long term for this product. This is day one. We're excited to be at the starting line here. We're really looking forward to the continued growth of this product alongside the rest of our 400 ETFs at iShares.
What do you expect the uptake, Jay? Hey, it's Alex in New York. Thanks to Katie. What do you expect the kind of uptake for all of these products are going to be? How rapid? How do we judge it?
Look, it's tough to say. I think we have to go back to the ETF structure itself and the access that it provides to investors. There's a lot of different investor types that can now access Bitcoin through our spot ETF, and so we're excited about that, and I think that will really kind of prove out over time.
Jay, my turn. I'm going to jump in. It's Guy. Look, if I buy a BlackRock model portfolio, is there going to be Bitcoin in there now?
I can't speculate on that. I would say that, again, this is about access to so many different client types in the market. You know, if we take a step back, there are people who have already had Bitcoin exposure, but would prefer it through IBIT, through the ETF itself that could be transacting in this product today. There's people who couldn't access Bitcoin, but now can because of IBIT being on the market. So this is about kind of providing that access to a wide range of investors.
Let's talk about who those investors are. So won't speculate on model portfolios, but is this product for retail or is it for wealth managers? Is it for advisors, financial advisors? What's your expectation of who will actually be buying this ETF?
Just like all of our ETFs, it's really for everyone. I mean, I think, what is this solving for, right? I think if we start with why does IBIT have appeal to investors, first, it's the access it's providing. So investors who want to see Bitcoin alongside their other portfolio holdings can now do so with an ETF. I think people who are looking for the convenience of an ETF in the Bitcoin space, kind of removing a lot of those complexities around the cost of trading or the tax reporting or deciding between hot and cold wallets, is providing that value. And then on top of that, it's really about the quality that BlackRock is bringing to the space, that institutional grade infrastructure that we've really been focused on in ETFs for over 20 years. So when you combine those together, access, convenience, and quality, that appeals to several different investor types.
All right, Jay, let's talk about fees here because fees across the board are extremely low. When it comes to the BlackRock product in particular, this fund will charge 25 basis points eventually. It does have a 12-month waiver of 12 basis points. And with that in mind, with fees so low, what's the break-even level of assets needed for this fund to be profitable?
I mean, I think investors focus on fees, but more importantly, they focus on quality. And when you look at, the 1,300 ETFs we manage globally, the investment grade technology we bring to the space, the professional level of risk management that's involved in this ETF, I think people see that this pricing is really competitive. And it's not just about chasing the lowest fee, it's about balancing cost as well as that quality that's coming in.
So that's the investor perspective, but from BlackRock's perspective, again, fees very low. Would you expect this to be a loss leader for a while?
No, we really benefit from the scale of our platform. 1,300 ETFs, $2 trillion in the United States. That allows us to really bring that quality at scale.
Jay, do you think the market needs all of these ETFs? Do you think there's going to be a winnowing process that takes place here?
I can't speculate on the market. I know that our customers wanted BlackRock to bring out the IBIT ETF. So, we're certainly happy to be able to provide that access today and to really solve a client need that we've been asked for over the last few years. This was a multi-year journey, listening to clients and knowing that we could bring a great solution to the market.
What would success for this product look like a year from now? Because, for example, iShares does have a few other crypto-related products. I look at the iShares Blockchain and Tech ETF, for example, the ticker there, IBLC. You take a look at that. That launched in April 2022, only has about $18 million in assets. What are you expecting for this product? What would success be?
I mean, look, this is day one. I would say success is getting here. I think this is so exciting to bring out a spot Bitcoin ETF to the market with IBIT. We've seen from clients over the last few years the interest in this product, and it'll sit alongside our broadest platform in the ETF space, over 400 ETFs. So I think the ability to get this exposure or to consider this exposure alongside all the other exposures we provide really allows investors to get that granularity they need in this kind of uncertain macro environment.
Hey, Jay, it's Alex again. When you talk to clients, do they have like a pot of money in cash? They're just like waiting and chomping at the bit to buy a spot Bitcoin ETF? Or do you get the sense that they're going to be like selling out of other stuff to buy this thing? I just want to get an idea of sort of how the money shifts.
It's really up to every investor to decide if and how they're going to allocate. We know that there's some people who have been waiting either because they didn't have that access before or they had a different way of getting exposure and they prefer the ETF. So it's really hard to make any generalizations.
And I do want to just follow up on fees a little bit more because, again, you're going with a waiver, and there's several issuers in this field who are going with waivers. You have the longest 12 months. Why go with the waiver? When I talk to analysts, for example, they make the point that financial advisors considering these products, they don't really look at the waivers. They take a look at the eventual fee, the long-term fees. Why go with a waiver at all?
Look, we want to be competitive, but at the same time, we really do want to focus on the quality that we're providing investors. So we know there's people that are excited to get into the space today. We know that there's people that might be waiting, but we really want to deliver that product quality first and foremost beyond the fees or the waivers.
Jay, thank you very much. We very much appreciate it. Jay Jacobs of BlackRock and Bloomberg's Katie Greifeld, thank you for joining us as well. I appreciate it's a busy day.
That was very good. That was Bloomberg Television. We had a whole host of cast there of anchors talking about this new Bitcoin for ETFs for Bitcoins. That was Jay Jacobs, BlackRock ETF executive, sitting down with Katie Greifeld, Alex Steele, and
Guy Johnson.
Guy Johnson, so we got it all covered. All right, James Safer joins us here, and this is the guy to speak to. He, along with Eric Balchunas at Bloomberg Intelligence, the leading research on ETFs, period. For as long as we've been doing this at Bloomberg Intelligence, these are the folks that really are on top of it. And they've been on top of this Bitcoin ETF because it's such a big deal in the world of ETFs. James, thanks so much for joining us. I know you're super busy here today. When we have 11 new Bitcoin ETFs hit the market, I don't know what to look at. Which one should I look at? Which ones are important? What are you guys looking at?
So I'm looking at all of them because
Okay.
I want to see how all of them are doing. The thing is, everyone's going to try to figure out what happened with flows, right? Problem is, we don't know what's happening with flows right now. I'm sure there's some trading desks and the authorized participants in the banks at these brokerages. They know what's happening with flows, but we won't see it till after market close today. That said, what we can watch is volume, and that's what I'm watching. We're right around $2 billion already and traded in all 11 of these ETFs. It's being led by GBTC from Grayscale, and then IBIT from BlackRock, and then you have Fidelity and ARK are following suit. Now, I think there's no, like I said, there's no way to know which way the flows are going in this volume. It's significant. This is a huge launch, but I have my guesses.
And the guess is we'll pay you for the guess.
Yeah. So I'm fairly confident that of this money, GBTC, they are trading with the tightest spread too. That's something else I'm watching, trying to see who's trading the tightest on that bid-ask spread. GBTC is trading very tight. So were most of these other ones. There's no one really trading out of line. But I think GBTC is seeing significant outflows. I've called for GBTC to see outflows in my research because they left their fee at 1.5%. All these other guys are at 0. So there's significant capital in there. It might be locked up with cap gains, but there's a lot of it that's going to be leaving because they don't want to be paying that fee anymore.
So how much money are these 11 likely to generate? How much money?
Generate as in flows or generate as in revenue?
Revenue.
Well, flows.
Yeah.
I guess
Yeah.
flows coming into. I mean, like we don't. Yeah, like are they going to all go out there and start buying Bitcoin, kind of thing?
Yeah, I mean that's exactly what's happening, right? They are going to be.
Right.
They're going to be buying Bitcoin. This money that's coming in. It's the question is figuring out how much of it is new money buying Bitcoin versus shifting around, like we're seeing likely right now at Grayscale. Money's pouring out. As far as how much money's being made, the only one making real money right now is Grayscale because they're charging high fee, but they're seeing money pour out. Everyone else, for the most part, most of them are offering 0 fee waivers. So it's literally free to hold these things for the next 6 months. So everyone's doing everything they can to get assets for the long-term play to keep those assets and then earn fees on them. And even the fees over the long term, they're really low. They're competitive with other ETFs in the U.S. landscape.
How big is this for? I mean, you guys, you and Eric and your team, they have a team. I'm like, we have to have a team for ETFs? And they're like, yeah.
Yes, we do.
So we built a team. How big is this Bitcoin thing in the overall scheme of kind of ETFs?
So we like to look at this and we like the media tends to cover like 95% of what is in your sorry, let me restart.
Yep.
The media tends to look at stuff. It's 5% of your portfolio, but the media spends 95% of it. And that's what's happening here with Bitcoin, right? Like we think these Bitcoin ETFs could get to something like 1 to 2% of overall ETF assets 4 or 5 years from now, crypto ETFs in general. But that's it. That said, this is really interesting. It's fascinating. There's politics at play. There's a lot of money at play. There's a lot of big names at play. I mean, I just mentioned BlackRock, iShares, Invesco, all of them.
One of the things that we've been talking about, like gold. How many gold ETFs are there? I mean, gold is gold is gold. How do you differentiate one ETF versus another? So how many gold ETFs are there?
I don't know the exact number off the top of my head, but it's somewhere around 8 or 9.
Okay.
So you'd be surprised. And a lot of them, so State Street is the main one. They offer GLD, but BlackRock also has one IAU. And each of those have a sibling that charges a quarter of what the other one charges. So GLDM, mini shares, and IAUM, also mini shares, essentially. And they just undercut themselves because they have enough liquidity in the other products. And then they offer this cheaper portfolio diversifier that people can use and only charge like 10 basis points to hold it.
My mind is blown right
Yeah.
now. So the SEC approval, this is not the SEC giving that stamp of approval to Bitcoin, correct?
Yes, correct. I mean, if you read the letters from some of the Democratic commissioners yesterday after they approved this thing, and Chairman Gary Gensler, he kind of approved this thing tongue-in-cheek, said the courts were forcing us. But at the end of the day, what they were saying is true. It's the reason why we've been saying the SEC shouldn't have been denying the Bitcoin ETFs in the most recent denials, because the SEC is not a merit regulator. Their job is not to say whether an investment has merit. Their job is to make sure that the proper disclosures are made and let investors decide whether it has merit. So they aren't supposed to be the ones dictating whether there's value here. Let the end investors choose, which is what's happening here, and why I think it's right that these things are now trading.
So just to be clear, because Rich Truman, my intrepid producer, pointed out earlier, what did Gary Gensler do from a vote perspective? Gary Gensler, the chairman of the SEC, did he vote for this, against this? Did he vote for it with like a big asterisk next to it, or what happened?
Yeah, I guess the way to think about it, what he's voted with an asterisk. So the way that the SEC is set up is it's by a five-member commission, right? So typically it's 2 Democrats, 2 Republicans, and then a chairman. And the person who appoints the chairman is the president. So typically, right now, it's run by the Democrats.
Okay.
So what happened here is the 2 Democrats dissented on this decision. The 2 Republicans agreed with it, and Gary Gensler was the deciding vote that got this pushed through. I think it was all a political move. The Democrats didn't want to have to do this. They didn't really have much of a choice as far as I'm concerned. So by Gary being the deciding vote saying, yeah, I know we have to do this based on the courts and these other things, but we really don't like it. We didn't want to do it.
I hate to get into politics when we're talking money, which is my preferred thing to talk about. But why would the Democrats not want this?
Yeah, Elizabeth Warren specifically has said she's raising an anti-crypto army. She hates the crypto crowd. I mean, I understand some of it. There's been a lot of fraud, a lot of manipulation, a lot of bad actors in this space. So I get why they don't like it, but that's not the entire space. And like I said, the SEC shouldn't be a merit regulator. They shouldn't be deciding whether there's merit in an investment. They should worry about the risk.
The SEC was also saying, we regulate securities, and we don't think this is a security, right? Was that also one of their arguments?
Correct. But gold is not a security either. It's a commodity. So Bitcoin technically is going to be regulated by the CFTC, but still the Bitcoin ETFs are regulated by the SEC because ETFs are securities, which brings me to another point. One of the reasons why these are so important is many of these institutions, they can't hold anything but securities or bonds, what have you.
Right.
This puts them in a wrapper that now institutions, advisors, and more people can play with Bitcoin. They can't touch the underlying stuff for the most part.
All right, so you and Eric are going to come out with some research tonight after the close that I have. What are you guys like really tracking? What's going to be? I don't know. What's your call here? We're 10:48 a.m. Has this been a good day for the ETF biz and crypto?
It's been an obscenely good day. I mean, we're probably. I mean, I haven't been at my desk for a while looking at the volumes, but I'm guessing we're over $2 billion in trading volume at this point. I mean, that is a monster day. That's not something you really.
That's a monster day for an ETF launch. Is
yes,
kind of how you're phrasing it.
Yes, exactly. Even still, like for a brand new ETF, it's exceptionally well. I mean, even if you take GBTC out, which is a trust that was trading over the counter, is now an ETF. These are still having very big trading days. Like even if these things were only trading this number, 2 billion, for the entire day after we take out grayscale, I would say that's a successful day. I said if they get over $1 billion, over 2 billion, I think that's a pretty successful day. We're only an hour and change into this day, so we'll see how it goes.
All right, we'll follow your research, folks. BI Go on the terminal for terminal users. Get the research all on the ETF business. James Seyfert, ETF research analyst for Bloomberg Intelligence. Thanks for taking the time, bud, coming into our studio. Again, some big ones I'm following: Grayscale, Bitcoin Trust, GBTC, the iShares one, IBIT. That's what I'm looking at. This is Bloomberg. All right, let's get some company news right now with Denise Pellegrini.
All right. Hey there, Paul. Thank you. We're watching Tesla and also Hertz because Hertz says it plans to sell a third of its U.S. electric vehicle fleets and reinvest in gas-powered cars instead. And it's citing weak demand and high repair costs for its battery-powered options. Now, this about-face comes after Hertz, you recall, announced plans back in 2021 to buy just about 100,000 Tesla vehicles. Tesla shares, by the way, they're down about 3% right now. Tesla also talking about raising salaries for factory workers. Home builders not exactly on the sunny side of the street today. KB Home reporting a drop in average selling price last quarter from a year ago. Bloomberg's Tom Busby tracking those developments for us.
The Los Angeles-based home builder reporting a year-over-year decline in its average fourth quarter selling price and is also forecasting weaker housing revenue for this year. KB Homes also getting slammed by a downgrade from an analyst at Seaport Global Securities who warns of risk to margins. Analysts at Evercore, though, have a more positive view, citing impressive guidance across all important metrics this year. Evercore also says additional upside remains for KB Home if market conditions continue their recent trajectory. Tom Busby, Bloomberg Radio.
All right, thank you, Tom. Bloomberg's Tom Busby there. And Starbucks is being sued by a consumer advocacy group. Now, the National Consumer League is charging that Starbucks' claim that its coffee is ethically sourced is false and misleading, and that there have been abuses on farms that supply coffee and tea to Starbucks. And those are some of the company stories we're following for you.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right. Right now, let's go get some world and national news with Amy Morris.
All right, thank you, Paul. The United Nations top court is holding hearings today for South Africa's allegation that Israel's war with Hamas amounts to genocide against Palestinians. A panel of 17 judges at the UN's International Court of Justice at The Hague is hearing arguments today and tomorrow. ICJ President Joan Donoghue.
South Africa contends that the acts and omissions by Israel of which it complains are genocidal in character because, I quote, they are intended to bring about the destruction of a substantial part of the Palestinian national, racial, and ethnical group, that being the part of the Palestinian group in the Gaza Strip.
Israel strongly denies the claim. President Biden's son is scheduled to appear in federal court today in Los Angeles on tax charges. Today's hearing will be an arraignment for Hunter Biden, who is accused of choosing not to pay more than $1 million in taxes and evading other taxes. House Republicans yesterday held a hearing to hold Hunter Biden in contempt of Congress for defying a subpoena to sit for a closed-door deposition. Now, he made a surprise visit on Capitol Hill, saying that he would only testify in a public forum. Biden's attorney, Abby Lowell.
Hunter chose a hearing where Republicans could not distort, manipulate, or misuse that testimony.
Now, Republicans have tried to tie Hunter Biden's business dealings to his father, but acknowledge they have found no concrete evidence of any wrongdoing. We're watching another winter weather storm system rake across the United States, and in Texas, homeless shelters across the state are buckling up for the Arctic air mass.
We slept 1,720 last night, so we are at our max capacity.
Terry Belling at San Antonio's Haven for Hope says starting tonight, they're giving priority to local families who are homeless. They're already seeing a spike in the number of parents with kids seeking assistance. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Lisa.
All right, Amy Morris, thank you so much. We appreciate it. All right, Lisa, I'm hopping on a plane tomorrow, 4.5-hour flight, much of it over water.
Where are you going to sit?
Where are you
I'm
sitting? Exactly.
In where I prefer to sit, which is an aisle seat.
Okay. A
And
lot
I
of people
see
do.
The
A
Wall
lot
Street
of people
Journal,
do.
The Wall Street Journal's got a great story out today. Perfect timing.
It is. Where is the best seat? That is the question that a lot
there
of
an
people
answer?
asking. There is kind of. Okay, so they spoke with the director of an aerospace forensic lab and an accident investigator. And he basically said, if you can tell how an aircraft is going to crash, I'll tell you where to sit.
Okay.
But he did give some tips. So he says the back of the plane has proved safer. He also says that's followed by seats near the wings because the wings have that strong structural component. You know, they're able to withstand a crash a little bit better. The exit row seats, you know, they're from, you like them for the leg room, right? But it's also the seat with the chance of a fast escape in case of an emergency. So keep that in mind. Now, a few tips, Paul. When they do the safety briefings, do you listen to them?
Negative.
Negative? Do you turn the music up on the ears? What do you just tune them out?
I've flown over 1 million miles. I don't know. They are making them a little bit more humorous and fun and engaging these days.
Yes.
So I have to give them credit there.
You're supposed to tune into those safety
I know,
briefings.
I
Okay,
know.
here's something else I want you to do when you get on that plane tomorrow. Count the number of rows to an exit. Because if it fills up with smoke, something happens, you can't see, at least you know where you can go to get to that quickest exit.
Well, here's one of the things which I do, and I taught my kids to do is have your seatbelt on at all times.
All times, yes. Oh, yes.
Just because you always see those stories where perfectly calm flight, then all of a sudden they hit this crazy turbulence, and somebody gets bounced up and bangs their head on the ceiling, and because they didn't have their seatbelt. So I keep it on. I can't say it's on, super tight, but it's on. So I feel like I'm doing some basic stuff.
And the kids do like the window seat too. So I don't know if that's the best idea now.
Exactly. I like to get out. So, but we'll see. Again, with these for Boeing, it's really key that they get these 737-900 MAX
grounded.
jets. Yeah, they're still grounded. They are making some repairs and everything. But again, for Boeing, this is critical because this is reputational. And they just had the 737 MAX issue from a couple of years ago, which they finally gotten past. And now this on the 900. Hopefully it's not nearly as broad as the one from a few years ago for Boeing's perspective. All right, we're going to have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to get the equity call from Joe Mazzola. He's the managing director, trading education at Charles Schwab. I always love talking to the folks at Charles Schwab because they have so many customers and they see so many parts of the market. They have a great view there. David Kudla, a friend of the show, he's going to give us his macro call. He's the founder, CEO, and chief investment strategist at Mainstay Capital. What did he take out of the CPI inflation print here? And then we're going to have bring you a simulcast with Bloomberg Television at around 11:42 a.m. Wall Street time. Loretta Mester is going to sit down with Bloomberg's Michael McKee and talk the Fed. Right now, let's kick this hour off with Mr. John Tucker.
Hi, Paul and Lisa. Stocks declining. Traders kind of dialing back their bets on Fed rate cuts after that hotter than expected inflation print this morning. S&P 500 trimming its weekly advance, led by losses at mega caps like Apple and Tesla. Still, Skylar Montgomery Koenig at Lombard Street Research sees Fed rate cuts sooner rather than later.
The market is looking for significant easing in 2024. There's no one that doesn't expect easing. I think the smallest easing that one is expected is 50 basis points, but it's all front-loaded. So the market prices around 200 basis points this easing cycle over the next 2 years, and I think that's fairly reasonable if you get a soft landing.
And the bond market seems to agree with her. Traders remain confident the Fed's going to embark on a series of cuts, totaling more than a full percentage point this year, no later than May 10th. Right now, the 2-year, 3 basis points lower. That's at 4.32, despite that data. The 10-year yield, that is at 4.02%. As for equities, 10 of the 11 major industry groups in the S&P 500 lower. Energy, the best performer, the biggest drags coming from real estate and utilities. And earlier, the S&P 500 did cross that record close that we had 2 years ago. Somebody pointed that out, and as soon as she pointed that out, we went lower. S&P, you're a jinx. S&P 500, 28 points lower right now, down 0.6%, 47.54. The Dow Jones Industrial Average, 204 points lower. The NASDAQ 100, that is down 89 points. That's down 0.5%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Lisa and Paul.
John Tucker, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can check that out over there. I'm looking at the Grayscale Bitcoin Trust. It's up about 1.8% today, 24 million shares traded. I'm going to the IBIT, which is the BlackRock ETF, the iShares ETF for Bitcoin. It is up 23% today on about 22 million shares of volume. So James Seyfert, who covers these ETFs for Bloomberg News, for Bloomberg Intelligence, he says that's what he's looking at, the total dollar amount being traded here. So some big numbers being put up in early trading. Let's check in with Jess Medin. She covers the broad equity markets for Bloomberg News. She joins us here in our Bloomberg Radio studio in New York City. Jess, what are you looking at?
Well, thanks, John Tucker, for that shout out about the S&P 500.
I'm just saying, you shouldn't have said anything.
If you look at where the S&P 500 is now trading at 47.55, about 0.8% away from that all-time closing high that was last reached on January 3rd, 2022. So that's 47.96.56 is the level to watch there to see if we can close above that on a closing basis. But you are seeing, to John's points, things pull back since then. But you were just talking about, obviously, what's happening in the crypto space, Paul. And so looking at this Bitcoin trading around 46,930 level right now. If you look at some of these individual names, though, these crypto-linked stocks, Coinbase, COIN, is the ticker symbol on this, down about 3% today, on pace for its worst day just since January 9th. And then you look over at Marathon Digital, MARA is the ticker symbol on this, down 6.6%. So also actually its worst day since January 5th, not that long ago either. So you're seeing some moves there. Other stocks, though, that I'm keeping an eye on, Chesapeake Energy, CHK, up 6% on pace for its best day since June 2002. So Chesapeake set to buy U.S. gas rival Southwestern for $7.4 billion here in an all-stock deal to create the largest natural gas producer in the U.S. If you look at Southwestern's energy shares right now, SWN is a ticker symbol on this, up